Cohen, Radigan, and Milan, as we are here to take you through the most remarkable day in my lifetime in the stock market. S&P 500 up by 9.3% right now. NASDAQ up a paltry 11.1%. Your Russell 2000 up 8.39% in today's session. The bond vigilantes have won, ladies and gentlemen. Liquidation overnight gets Trump to tap out. On Futures Power Hour today, we were privy to that announcement. If you joined the 1 p.m. Eastern show, you saw us react in real time to the news that the tariffs would be lowered against the 70-plus countries that have come to the table for negotiations. There's a little caveat
and
there.
did not retaliate. The ones that were nice and obedient servants of the king.
Those that kept their fealty to the empire will be rewarded. In turn, we see that Chinese tariffs will be increased to 125%, which sets up a pretty funny bit of math, which we're going to have to look into here shortly, about what the U.S.'s effective tariff rate will be moving forward. And here's a hint. It's higher than it was then this morning. Nevertheless, it's the relief that the market needs. If we're not cutting off our trading partners, they will continue to buy our debt. We had an excellent 10-year auction today, the second best bid to cover ratio in history. Minutes later, we get the announcement from President Trump himself. Bond yields get off of their highs, which was a scary night overnight in Asia.
My God.
I was trying to get out of my positions and it was not getting filled. And I'm here sweating. I told Ilya, it's like 1 o'clock in the morning. I'm almost throwing up.
Oh yes, there were many frantic texts as both of us were looking at our bond positions, going, oh no, wait 2%, 3% on what? And it certainly got really hairy going into Europe. I was pleased that my exposure was in TLT, so all I could do was watch in despair and couldn't actually do anything, because if I had the freedom of managing my positions, Lord knows the damage I would have done.
Well, the damage wasn't too terrible for me. Today was a relaxing day.
Yes, this is a whole lot better than it looked at the bottom of that wick.
Yeah, ZB only fell 23 ticks, but really, the story now is of what Trump said himself. Jamie Dimon told him he was going too far, as he just said at the White House. Bonds were going too far. Markets are getting a little yippy, in his exact words. We found real proof, ladies and gentlemen, that the put is not in the stock market, it's in the bond market. The Trump put is in TLT, not in SPY. Do we have a level to trade around now for the rest of the year, ladies and gentlemen, in ZB, right around 112? Those lows that you have at this.
What a low.
What a low. They will not let yields move back where they were at the start of the year. That is a very important observation here. But you know what? Yeah. That's not just the day-to-day. We have to talk about the basis trade, what Japanese fund may have blown up overnight. We also have to talk about the move in gold and silver. Gold up 4%. Thankfully, silver getting some of it back. Dylan, you're the laureate around here. You're the one who has the best market memory. You've lived through so many crises and have come out on the other side better, stronger, harder, better, faster, stronger, as they might say. What do you make of what you've seen this week? Did Trump just show his cards with the bond market comments today?
I mean, I have two thoughts. One, I had a conversation with Rich and the guys at IG in London this morning, and we had this exact conversation, which is where is the discipline for the Liz Truss that is now called Donald Trump, the sort of idiot politician making unilateral economic policy, and the obvious answer was the bond market. So the two couple thoughts. First, obviously, the bond market is the most powerful thing on earth, more than any president, more than any trade alliance, more than any currency. The U.S. bond market is the most powerful lever of power in the material world. And I'm really wondering if Trump has become so predictable as to be the 2025 equivalent of the 2024 oil trade whenever there was saber rattling in Iran. And basically, every time you get a rally like this, he's going to start to wind up tariffs again. Market's going to sell off. When it sells off, he's going to then back out. Basically, it's like an idiot child with a real economic nuclear bomb who doesn't understand and thinks it's fun to scare everybody. It's like somebody with a machine gun in a nursery school swinging the gun around and thinks it's funny, who's drunk. And so it's kind of a sad state of affairs for the world, to say the least. But it does make me wonder if this has actually become somewhat predictable, and that he's always going to threaten something to get he feeds on attention. He doesn't have there is nothing else. And so he'll do whatever the next thing is to get him the most attention. And so he needs to make threats to accumulate attention. And then he needs to relieve the threats to make it to continue to accrue attention. The difference between this and past crises is in the past, financial markets would adjust their levels based on some real external event, whether it's the global pandemic, a financial crisis, too much leverage is almost always, one, right? No one has ever seen a situation where the global financial markets are in a full panic, crisis, crash, rally, whatever you want to call this.
Sure.
Because of the idiocy of one political leader. It's a sad day for the world. Today only makes it worse, honestly.
Well, that actually is I think the key takeaway to all of this is, I think, exactly what Dylan said just now. Why didn't the markets freak out about the tariffs in November? Because the tariffs themselves are not the reason they freaked out. When we got into the beginning of this year, it's the implementation of the tariffs being erratic and the uncertainty therein, and not just the tariffs, but also the Doge thing, the immigration thing. The rollout of everything has appeared so chaotic that you started to see it in consumer confidence and in business confidence. That's what the markets didn't like. Tariffs, no tariffs, whatever. All of these things were perfectly digestible depending on how they would appear as a concept when the election occurred.
Sure.
It's when business confidence fell away and consumer confidence fell away that the market said, okay, this is a cyclical risk now. This is a risk to growth. And then when Liberation Day comes, notice when it's initially the confusion that it's 10% across the board, the markets rally.
Oh, I was feeling good.
They rally because they have certainty.
Right.
This is not about anything other than uncertainty around implementation and what that does as a dampener on economic activity. It's only when the foam board with the many rates comes out and you start to go, wait a second, these are going to be bilateral negotiations until the end of time. We're never going to get any certainty. You're going to negotiate these things from Bahrain to Botswana one by one? What? This is going to take forever. How could you ever have any certainty? You notice then that the thing that happened today actually adds more uncertainty because it shows that the thing can swing this way, it can swing that way. When it's time for the season finale, today was implementation day, there is a cliffhanger of some kind at this point, almost guaranteed, it seems. And so the show goes on, but do the markets have any more certainty? No, less. And so,
other than that's what I'm sort of speculating, Ilya, is whether the certainty is that he will always make the play for attention and he will never go through with anything that he says.
Guys, he's a real estate guy. The rates went too high. He's a real estate guy. If the whole plan is to refinance the debt and lower rates, you can't have a 4-year yield goes from 3.85 to 4.5% in 36 hours because of mishandled policy, right?
No, definitely not.
He tapped out.
But also look at the upshot. Look at where the S&P stopped. Just as a benchmark.
Hold on.
Does this change the recession that's probably coming?
Yes.
No.
Yes.
I don't think it does.
Yes.
And I think what you're about to tell us about net tariff rates is why it doesn't change it.
That is, yeah. Do technicals matter in this market? There was an astute observer the other day who pointed out that how can you follow technicals in this market? Fair point, right? This is uncharted territory. Technical analysis itself is predicated on the idea that past price action can help in some degree be informative about what the future may hold. After all, it's price. Price is a reflection of human psychology. Human psychology has not changed in any significant matter in 2,000 years. We're still running around with the same meat bag machines in our head that make us make the same decisions and feel the same emotions as the people in the Roman Empire did. So past performance actually in some way may be indicative of how the market may unfold moving forward. In this environment, do we have many corollaries here? No. So what do you do, right? Technical analysis does not necessarily hold. But where the market decides to stop today, perhaps in Ilya's parlance, let's just drag up the underside of the recent S&P 500 range here. That's fascinating. Because it's right around Liberation Day where things really start to fall apart. You can see similar type of price action in the NASDAQ. And there's some funny thing about this math. So let's set the stage. Donald Trump today, Truth Socials, and I quote, for those that weren't here, by the way, on Futures Power Hour, you witnessed this in real time. For those that haven't seen this yet, quote, based on the lack of respect that China has shown to the world's markets, I am hereby raising the tariff charge to China by the United States of America to 125% effective immediately. At some point, hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. Conversely, and based on the fact that more than 75 countries have called representatives of the United States, including the Department of Commerce, Treasury, and the USTR, to negotiate a solution on the subjects being discussed relative to trade barriers, tariffs, currency manipulation. There we have it. The trade barriers, currency manipulation, non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States. I have authorized a 90-day pause and substantially lowered reciprocal tariff during this period of 10%, also effective immediately. Thank you for your attention to this matter, as if we haven't been paying attention to anything else. Okay, so let's work through some math here, folks. Very plainly, we take all of the tariff rates that were presented to us last Wednesday when he held up that ridiculous whiteboard of doom in the Rose Garden. The U.S. effective tariff rate would have risen to 21%. Now, this is variable here because we don't know if this 10% tariff rate applies to Canada, as in it's now 10. Is it not applying to them, so it's still at 25? Is it a combination of 25 and 10, so it's 35? We don't know that yet. The White House has been reached out to by several officials. White House officials have been reached out to by several reporters. Those reporters have not received a response yet, so keep that in mind. But assuming that these are the numbers in Trump's Truth Social post, with China going up to a 125% effective tariff rate, the effective tariff rate that the U.S. economy has right now is no longer 21% from when we started the day. It's now 25%. Tariffs are higher now after all of this is said and done. After the 12% rally that we see in the NASDAQ today, the effective tariff rate for the United States is higher now than before Trump's announcement at 1:18 p.m. Eastern Time. So, Ilya, this is the only question. This is the only question in the world that matters here right now. Sell the rip or buy the dip.
Sell the rip. Sell the rip. So I was, as you know, selling put spreads at the start of this week, Because in my mind, there was a strange thing in the price action on Monday.
You did good,
where the news didn't get better, but stocks stopped falling. And so I looked at that price action and said, let's take a shot. Why aren't they falling? They should be. Or at the very least, nothing about the reason why they were falling has changed. But they've stopped. Today, we get this reprieve. Obviously, the markets storm higher. I've booked out of this. I'm done. I'm closed out. And it's because this does not change the fundamentals of what any of this means for the economy, which is why the markets decided to be afraid of it in February in the first place. Again, the markets could care less about this drama. They care about what it means for economic activity. And this uncertainty is prolonged. These tariff rates, as you've just eloquently illustrated, are net higher. This is a bigger hit to growth, not a smaller one. Break-even inflation rates are falling to tell you that whatever uplift to inflation the Fed was so afraid of, if you read the Fed minutes today, that's going to be overwhelmed because demand is going to fall out of the bottom.
Mm-hmm.
The markets are looking through the one-off adjustment to price from the tariffs and saying, right, yes, one-time adjustment. And then the next thing that happens is the economic impact of your one-time adjustment, which is a deep and horrible recession that so overwhelms your one-time price adjustment that inflation expectations are sinking.
Okay, but let me give a counterpoint to that, perhaps.
Sure.
Dylan, at 125% rate for China, we're in the territory where trade effectively is dead between the two countries. We could go up to a 200% tariff level right now.
I mean, 500. These are funny numbers now.
Yeah, right. Like I see the feed here, which I really appreciate the people participating, right? There's no TDS in this comment, I promise. But there is a certain point where when you rise to a certain level, you're killing trade, right? So at 125%, for example, we saw numbers that were released today by the WTO. At these tariff rates, 80% of trade between the US and China would stop because it just becomes too expensive to do. And so at that point, you go to 130, 150, 200. The impact is already there. It's already priced into a certain degree. And it's such a ridiculously high number that the market says to itself, there is no way that this is actually going to happen. It's so outlandish. You're really going to take the world's two largest economies. You're really not going to see some bigger escalation between the world's two largest economies. There's no precedent for that. I don't know, Dylan, China is the country that
War of 1812, I guess. I don't know.
Well, I would point to World War I, but this is a country that endured the Great Leap Forward and decided to stick with the CCP. Yeah. It seems like the tolerance for what the CCP wants to accomplish historically is very high. No.
The tolerance on that side seems probably greater than the tolerance on this side.
Well, regardless, though, it feels like a funny number, right, Dylan? Like, this is so astronomically high that it clearly has to be a ploy to bring them to the negotiating table.
But I mean, obviously, he's going to bring that number. If you think that he's not going to back off of that number,
right?
There's a bridge to be sold in New York, right? I mean, come on.
I mean,
this is a joke. This whole thing is a joke.
And that what makes this such a double-edged sword right now for traders, because you obviously have this rip-roaring rally. The tariffs levels are being lowered and eliminated for most trading partners, which is a good thing. And quite frankly,
more than that, the president is proving it's all bark and no bite.
That is part of it, that maybe he's not going to follow through if equity markets and bond markets
punish him. It's not so much what he announced, it's so much that he announced anything indicating that he actually has zero credibility.
And the tariff hit is actually bigger.
No, but this whole tariff discussion is a carnival sideshow that's never going to happen.
I think that, Ilya, I think like we have to weigh these two factors here, right? If you're placing your next trade, do you care more about now that the tariff rate is actually in reality higher than it was before we started today's session? Or do you care about the fact that because the barriers against most other people that we care about, our allies, our strategic geopolitical partners, all of the people who are going to need to fill in the gaps of the supply chains that we have out of China, if we were to do some global reshoring among allies, maybe the factories don't come back to the U.S., but we drop tariff rates between, say, the U.S. and all of South America. And so you can't probabilistically say this is going to be a fade. This is definitely a buy still.
You don't have to make the decision between those two options. It's option 3, which is what Dylan said.
Which is?
Nobody knows because the whole thing is still erratic. It still changes on a dime. And businesses are ultimately still not going to have the confidence to put together a 5-year industrial build-out plan on the basis of this, because this policy is fickle and changes too quickly for anybody to output capital and take it at face value. And so the hit to growth remains.
The hit to growth, and I would say the hit to growth remains, as well as the marginal disinterest in doing business with the United States.
Yes. Because nobody can still look like, if you're a purchasing manager anywhere in the known universe now, are you going to take this and say, okay, my supply chains with the US now look like this. I can project out a year, 2 years, 3 years, what my inventory levels should be, what demand is going to look like, what employment's going to look like. Are you any wiser for having heard this today? No. So sentiment in markets has improved, of course, because the markets were getting hit in the head with a tire iron, and now the hitting has stopped. Well, that's great, but your head is still bleeding.
And you still have somebody in the room with a tire iron who'll swing it randomly at any time.
That's right. That's right.
Yeah, but didn't we just learn today that if Bill Ackman cries enough on Twitter, like, he'll just. If Jamie Dimon, Bill Ackman, if Scott Bessent we talked about this yesterday. Scott Bessent flew down to Florida apparently on Sunday.
Oh no, the interview that Bessent did with CNBC yesterday.
He's beclowned himself. Bessent's really embarrassed himself throughout all this.
I'm saying the one he did yesterday in particular. If you watch it, the level of apologetic, I'm sorry, everyone, I didn't realize it would come to this. That was the undertone to the whole affair, was just so transparent that it did look like the administration would eventually blink and at least some cooler heads would prevail. Frankly, watching that Bessent interview made me happier buying risk yesterday because it looked like the facade was melting.
We are halfway between, effectively at the underside of the range here. If you're talking about SPY, where we bounced from starting in mid-March, March 12th, prior to the breakdown from Liberation Day, you still have IVRs that are in their mid-50s here. The lows are probably in for the foreseeable future. Whether or not that means we're going back to the highs is a completely different question. But while there's still volatility to harvest, there's a good, at least I think there's a decent opportunity for traders to examine directionally neutral strategies, short iron condors. I prefer short iron condors to short strangles personally because of the defined risk nature of them. But this feels like that kind of environment that we should be playing in. I don't think we're out of the woods by any stretch of the imagination with equities, right? It's probably going to be choppy here moving forward. A disciplined long-term dollar cost averaging, right? Earlier this week, Ilya, if you have a very different mindset in your trading portfolio versus your long-term investing portfolio. Long-term investing is just accumulation. You buy stuff, you put it in there, you stash it away. You don't plan on touching it. Your 401k, your Roth IRA, those type of things. This is a great environment to get down in. Monday, we talked about what we'd go on for discounts, right? The Metas of the world, the Googles of the world. You were looking at IXUS. We were talking about, Dylan, the second generation AI names. IXUS is up 7.39% today. Meta here is up 14.8% today. The AI super cycle isn't over, Mr. Radigan. We still got another fight left in us. I think we can trade around the lows now. Trump showed his cards. The Trump put is real. It's not in SPY.
But would you get? But would you? Where would you sell the rally as much as you wait to buy a dip?
I'm much more confident selling against the lows in TLT than I am in SPY. But on dips around this trade situation moving forward, even if the market digests the effective tariff rates and says, hold on a second, tomorrow we get a little bit of a pullback, I think we have enough of a low where our wedding crashers trading mindset, right? Selling put spreads against the low. I don't necessarily think you're going to rally. I just think that you're not going to fall. That's still the right way to do this. I'm not convinced on the bull side from here after 12%, right? Directionally neutral from here, maybe buy the dip on a pullback, but if you get a further rip from here, it's an opportunity to sell. I don't think you need to be directionally married yet, even if you came into today like this. But the bond story is really the most significant part of all this. Last night, Ilya, it was melting down. I'm in futures, and I'm out far enough where there's not a great ton of liquidity in ZB futures at 1 o'clock in the morning Eastern time, and this thing is eating dirt. But we do stage a turnaround. It seems overnight that we have a Japanese fund or two that blows up regarding the basis trade. Basis trade is a fun trade. If you're really looking to make money, free money, when it's easy out there, if you're an institutional investor, you work at a hedge fund, you go into the market, you buy the cash futures, the cash bond, and you also then sell the futures contract, the synthetic futures contract, right? Why are you doing this? You're trying to capture the differential. Less trade costs, less transaction costs. They have to converge. So if you hold the cash bond position until expiration day and you're short the futures, they will converge at a point and you're guaranteed to make the difference. It's called the basis trade. You lever that up 50, 100, 200 times, you're starting to print money in good markets. 2 times in history has this broken down before. Long-term capital management, 1998, during 2020, March of 2020 during COVID. There was just no liquidity in the system. It's drying up. It looked like it was drying up overnight last night. The basis trade was blowing out for people. You see 10-year, 20-year swap rates in the interbank market moving to some of the most extreme levels on a one-day basis in history. And it spills over with these Japanese funds that are ultimately being liquidated overseas. We get through our trading hours here. ZB is back up to 115 and 12. Casually where we were at the end of March, like nothing's happened. Same thing for ZN. This is now only a 0.62% loss on the session, but hey, we're holding up against former support here. I feel as compelled as ever, given where Trump just tapped out. If you are a bond trader in these markets, if you're trading TLT, ZN, ZB, the swing lows that we just established today are the Trump administration's pain point. They want to bring down yields. They want to bring down housing costs in the midst of a tariff where you're going to have to bring down mortgage rates. But they want to bring down the cost of financing a car. They want to bring down revolving credit rates, like for consumer credit cards. You're going to need lower rates across the curve. And the second we see bonds cross that threshold of moving out where they were prior to the announcements, bond market rings the bell. Trump himself said it today. The bond market, he's paying attention to the bond market. And he says the bond market is now beautiful again in typical Trump parlance. That's your line in the sand. Today's lows in ZN and ZB, you can I will be trading around them like they are as good as gold. They're going to be rock walls for me. If we're below them, obviously none of this matters. But that to me is our defined level of risk. That's the tap out point. The Trump put is in TLT, not SPY, this administration. Ilya.
I'm long. I mean, I
long the bond.
I'm long TLT verticals. I have quite a bit of duration in them still. And they're probably the closest following to ZB. So if we take a look at ZB here, even the current contract, it was obviously an absolutely insane night. The wick on it looks just crazy. But I think, first of all, there's clearly a pain point for the administration here, to Chris's point. And secondly, even just more near term, if what that was an unwind of the basis trade and a bunch of other things, inherent in it is why that happens in the first place. Why do people freak out? Why do these trades suddenly start to unwind? And Chris, this is the image I was sharing with you earlier. When we look at that insane bond rally or a yield rally, bond sell-off on Monday this week, what we find is that inflation expectations are not what's doing it. It is a massive surge in term premium. That is to say, if you want duration in this market, you got to pay for it. Because nobody has any idea what's going on. There is a ton of uncertainty. If you're going to be borrowing money with any kind of time on it, people want to get paid through the nose for that extra time because of how unhinged and uncertain the environment is. And that then ripples out into failing basis trades and closing hedge funds and all this kind of thing. People panic because the fog is so dense. And the way you see how dense the fog is by looking at the term premium and watching it surge. So then two things. Number one, the term premium unclenches here if the put is really in the bond market, as I think Chris suggests, and as I would agree. Moreover, we have CPI tomorrow, and we can see from the minutes that the Fed just published that they were so concerned about inflation, and we can see that the market is telling them now since the beginning of April, which is obviously after they had the meeting. The net impact of the tariffs on inflation is negative because the growth hit outweighs the price adjustment. Fed knows this now. It can see it. They have their answer. If the FOMC minutes tee up the question, the price action since has given the answer. The Fed no longer has a barrier to cutting rates. Their barrier has fallen away in practice. They told you what it was, and you can now look and say, is it still there like it was when they were talking? Nope, it's gone. So you get a soft CPI number, and the expectation is we're going to get the first 3% core reading since 2021. You get even a little softer. And, I mean, the Fed is already priced in for a cut in May.
We want a lot softer because if the tariffs do what they're going to do, they're still going to lead to inflation jumping up, right? I mean, that's the whole thing about this.
The markets have looked through it already.
Today feels.
At least that's what the break-even rates are telling us.
Well, yeah, I mean, that's the funny thing. If you look at different measures of inflation expectations, Dylan, there's a very clear cutoff. That cutoff seems to be like December 2026. The market seems to be convinced that no matter what happens between now and December 2026, we're going into a different regime thereafter. Yeah, the market's up 12% today, and the S&P's up 9.7%. And I've read the chat. I'm reading it here. I'm entertained, so I appreciate everyone participating. But people saying that the market's now, 12% today. What do you have to say about tariffs now? We were at 6,200. We were at 6,200 a few weeks ago. What do you hear yourself? We still erased like $8 trillion worth of equity market value. Yields are higher than where they were.
And permanently obliterated credibility. We've
damaged our relationships with our trading partners all over the world, right? We didn't get any respect back out of this. There's a great analogy here. If we're all playing a game of poker and I lose a hand, and in response to that hand that I lost, I take my hand and I swipe it across the table and wipe everyone's chips off. And everyone calms me down and is like, okay, all right, I'm sorry, everyone. I'm sorry I did that. That was unbecoming of me. people are going to treat me differently sitting at that table with them. They're going to have in the back of their mind, okay, when Chris has a losing hand, he's going to start to get angry and he's going to try to flip the table again. They will treat me differently thereafter. They'll also read my emotions differently because they'll see, oh, he's getting angry. He has a bad hand. I better take my chips and protect them because I know what comes next.
And maybe I don't invite him to the next game over at Ilya's house.
That's right.
Because he's a fruit bird.
I mean, that's the other side of this here. Like right now, a lot of countries are relying on us and we rely on them for various things. It's a nice symbiotic relationship. We're taking the mafia enforcer approach, which is one way to do it. Not my cup of tea, but maybe it's accomplishing something. I don't think, though, people can turn to today's action and say, see, it all worked out. It hasn't worked out yet.
Definitely not.
It hasn't worked out yet. We have a relief valve today, for sure. But the effective tariff rate now at the end of today is higher than when it started this morning at 12:01 a.m., when all of the tariffs went into effect. And so if we're talking now, listen, the goods components manufacturers, all those small manufacturers, all the layoffs that were coming, that is not going to happen immediately. Those that are relying on China have a real problem on their hands now. But because we're not cornering out Thailand, Malaysia, India, Vietnam, right? Because we're not closing off the entirety of the supply chain, there is an opportunity now to find new sources. The fallout is not going to be as severe as it otherwise may have been. I'm not ringing the alarm bells. I was ringing this morning or over the past week on Twitter anymore because we're just not in that world. But we're also not out of the woods. Fed's not going to cut in this environment. If the Treasury market starts functioning appropriately again, we don't see this basis trade blowout rankling things in overnight hours. Credit markets aren't blowing up. The Fed's not going to come in with support. This modeling today, we can simply take the CPI basket. We look at the imported goods component of that basket. We take all the countries out of that basket and we tinker with the new tariff rates one by one. China 125, Canada, Mexico 25, this country 10, that country 10, yada, yada, yada. Shove it all back in, compress it. Where's inflation going to rise to over the next year? Ceteris paribus, all else held equal. You're now looking at a 1.8% year-over-year rise in inflation from where we are right now. That brings headline CPI to 4.4% at a minimum. So we're not out of the woods right now. If you made money in the long side, again, this is a speed dating market. We're not looking to marry. We're not looking to marry anyone here. Ilya, you speed dated this week.
Oh, very much so.
And look, you're feeling like a king.
I'm feeling much better than I did when I dipped my toe in. I'll tell you that much.
It is still bizarre world that you were pressing the logs harder and faster before I was today. Doesn't make a lot of sense to me. So Dylan, what's the next move here, though? I mean, like, we know that there are economic realities on the ground that still exist. The second Great Depression isn't staring us down, but we still have rocky seas ahead. What do you do with stocks?
Boy, I think the safest assumption is that the China tariffs also won't happen. So because the same way Iranian retaliation in Israel is predictably theatrical and not lethal.
Sorry, Trump just said he didn't realize that the tariff pause would have that impact.
Oh, great!
Come on, man.
Great.
That the Trump withdrawal of whatever threats is basically as certain as the non-lethality of an Iranian missile attack. And so the only factors in place are, one, America's run by an erratic and unreliable leader who has absurd tendencies towards extreme statements and takes pleasure from making the whole world bow to his will. All of the growth will slow down and confidence will be reduced as a result of that fact. But also that Amazon, which is probably the most directly related to the China trade, like if Trump is going to shut all trade with China, that would, I would think, would hurt Amazon. I would think that would hurt Apple. There's probably a decent list of 10 companies. Nike in Vietnam, right? I mean, I don't know. Maybe Vietnam was one of the friendly and subservient nations that it was given a stay of execution today. I don't know. But I would buy the names that benefit from when Trump withdraws his China tariff threats. And I would still continue to harbor into the defense of the consumer discretionary, telecom, all that jazz. And it sounds like you want to own the bond.
I mean, I think
it sounds like rates are going to come back in for a minute because now the bond market has established primacy over Donald Trump. And so if the bond market has established primacy over Donald Trump, it does clear a pathway for higher bonds and lower rates, maybe.
And so we're back to regular recession.
Right.
Just regular recession. Not a
regular
meltdown.
Recession caused by American policymaking.
Yes. Yeah, so like we're in a better position than we were this morning.
Yeah.
In a sense. We're still in a much worse position than we were a week ago.
Oh, 100%. 100%. We are now going into a regular recession whereby if the bond market has a conniption, there will be a reprieve, but the growth hit will not be countervailed. The certainty
but also
will
the tariffs
not be
won't
happening.
Right.
Well, maybe they will, maybe they won't. We're going to keep doing the great and powerful tariff show probably for the next 3 years. And so the markets ultimately will have the recession that they're going to have because there's no certainty and businesses don't spend money if they don't know what they're buying.
Trump says that he didn't realize the market impact here. Understandable. Self-proclaimed smartest man in the world. Bond market's difficult to get. That's why so many of us are figuring it out. But legitimately, I was very fearful of what would happen to supply chains. Like I know this. I shared this with Tony yesterday. He's complaining about people being multiple tariff and COVID experts at the same time. I happen to sit at the nexus of that by virtue of trying to start a manufacturing startup during COVID. So I'm intimately familiar with the import-export laws of this country and what needed to be tailored to actually build the certified masks in order to get them out the door into hospitals. We are away from the worst case scenario of the entire economy facing a sudden stop. That is a huge relief. And if you were shorting the stock market or the bond market for the past week, you can say thank you to yourself for saving the economy. Bond vigilantes saved the day. So if you've been making money short SPY, TLT, if you're making short ES or ZB, we have to thank you for turning this ship around.
I know I did my bit.
I'm not joking. I mean that very sincerely. If the market didn't punish Trump for this wouldn't have come to some sort of change of direction today. So from the bottom of my heart, because I've talked to all the small businesses in town who are like, yeah, we have like 3, 4 weeks, 6 weeks of working capital. And like, if the tariffs go into effect, we have to shut down. There's no way to source our supplies for the hardware store. Right? That business is going to stay open. Thank you for shorting the heck out of this market and keeping small businesses in America open. And thank you for giving us a defined level to trade around here moving forward, because we know where the tap-out point is for the Trump administration now. The Trump put in TLT hereby resides at 85.57. I will be trading around that level. I will be trading around that level for the rest of the year like it's ironclad until it breaks.
I mean, I took the news today to say I know that ZB looks bad right now and TLT does, and I'm a bit upside down on these longs, but I've just been told to stay long. So, okay, I will until I am told otherwise.
Dylan, what's the play now going into tomorrow?
Come on. I mean, the madman play is to get short.
I might do that, just not yet.
But it would be awfully soon to do that, though. Gosh,
Yes.
The madman play is to get short. The prudent man's play is to stand by and watch a minute. And the sort of moderately risk-seeking fellow might buy some bonds. How about that?
Apple has a real problem on its hand here, folks. Apple's up 15.3% today, which is just wonderful. Love that. What's not wonderful about this is that if Apple wants to shift its supply chains immediately, it's probably going to push up the cost of an iPhone to $3,500. Let them eat cake, of course. No one's entitled to iPhones. Sure, okay. This is America. People and their definition of freedom is buying stuff. You want to work so you have excess money so that you can use it however you want. For many people, for the median voter in this country, that's what freedom is. That I can do my job and that I can do whatever the heck I want with the money that I've just earned. I want to go paragliding. I want to go to a theater. I want to go on vacation. I want to buy new power tools for my wood shop. So be it. When inflation's too high and the cost of living goes up too much, people can't buy their crap. Me included. Makes them angry. Apple has a problem coming down the pipeline because we're not going to be able to buy the Apple crap. I have half a mind right now to go out and do I need a new computer? Yeah. Does my wife? Yes. She's at work right now, so she's not listening to this, but should I go buy her a MacBook today? They still have them in stock at the nearby mall. All that's going to change. So there are real supply chain functions that are going through here. Today is a relief rally among relief rallies. I would also remind people that we have seen some very, 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 very vicious bear market rallies over time. Bear market rallies have been fast and furious. We've seen them evolve from all sorts of places and circumstances. Biggest bear market rallies of all time in the S&P 500. And I have to pull this up here. There we have it. Biggest bear market rallies of all time. Financial crisis. From November 2008, you get a rally of nearly 25% from the low, right around the Troubled Asset Relief Program.
I have a particular scar from that one. It nearly gave me a heart attack because I was long dollars, and of course that was basically just inverse of the stock market. My God, that one was bad.
.com bubble, summer 2001. You have a 20% rally in the NASDAQ. You get a 20% rally immediately after Black Market, the Black Monday crash in 1987. During the oil shock, you have a 15% rally off the low. During the China slowdown, there was initially a 20% rally before continuing on to new lows. The point is that the stock market is going to find relief valves or can kind of clear the deck of risk and reset the table. And we've reset the table here today. We've cleared out the risk of the worst case scenario being priced in two markets now. It raises the question, as Nick and Mike were talking about today, though, what happens after a rate cut? The Federal Reserve, I'm hard pressed to think it would cut rates given the inflation outlook. But if it is cutting rates due to the inflation outlook, you're talking about rate cuts for recession reasons. And rate cuts for recession reasons aren't good. Since the early 1980s, when the Fed has done these recession rate cuts, the average return of the S&P 500 1 month out is minus 2.2%, 3 months out minus 14.3%, 6 months out minus 12.8%, and 12 months out minus 11.6%. Got to be really careful what we wish for here. Unless you're in gold and silver, because my goodness, I'm going to definitely talk up my book here. The U.S. is an unworthy counterparty. It is an untrustworthy counterparty. It is flippant. It is capricious. If this was not my home country and I was watching this from the outside, I would be dunking on it so hard. This is not serious policy led by serious people. The excuses being trotted out don't make any sense. Bessent told us today he went down to Florida on Sunday, and he said that it has nothing to do with the bond market reaction. Trump turns around and tells us that the market was getting too yippy and that the bond market is really beautiful. So Bessent, like Kevin Hassett, has no credibility whatsoever. Peter Navarro I like when he talks because I think the interactions that him and Elon Musk are having are quite entertaining, right? Like
also, Peter Navarro is consistent.
It's like two of the worst people you know are fighting. I'll watch.
Yeah.
With gold,
I disagree with 100% of everything Peter Navarro says on economic policy matters, but at least he's consistent.
Yeah, actually, Dylan, speaking of consistency here, I've seen many people in the chat say this too. Let's just go to the heart of the matter here. Intellectual consistency is very important to me. Didn't we just have a whole round of DEI hires in academia get kicked out of their jobs because of plagiarism? Peter Navarro is a guy. Peter Navarro is a guy who plagiarized, made up sources. He writes Ron Vara in all of his books as a source. It's just his own name, an anagram for his own name. Okay, we've known this for years. He's still held in high grace. The guy is a joke. He's a clown. Elon Musk is 100% right here. The fact that he's held up in high regard when there was just all these get rid of all the plagiarists, right, in academia, and Peter Navarro ran as an anti-growth Democrat in San Diego and lost twice. Like, this guy's a serial loser. Why are we taking any ideas from this guy whatsoever? And now,
because he wrote a book. Because he wrote a book that was entitled "Death by China."
How did he get into Trump's orbit, by the way? Oh yeah,
because they Googled for the book because Trump liked the book title on Amazon. He thought it was a cool name.
And that's
so
why
they brought him in because he wrote a book with a cool name. And that's what's going on.
That's why gold's so good throughout all this. Last few days were rough, but we're away from the edge now where people are selling everything nailed to the floor to raise capital. In a world with the U.S. behaving as it's behaving right now as an unreliable counterparty at the federal level, do you feel better allocating your incremental unit of currency as a reserve into U.S. dollars right now, where trade relationships and capital flows can move on a whim? Or do you want to put it into something more stable, a little bit sturdier, something that has legacy, something that you can pass on to your kids? Gold's looking pretty good here.
What? You running a late night coin ad on me here? A little
Couldn't help myself.
Insomniac's delight, a little gold coin action at 2 a.m.
Right, yeah. It's like on Comedy Central after the Girls Gone Wild tapes, right? Like it's the remember those commercials in the 2000s?
Pass it on to your children.
Right. Now it's time for the gold coins and various experimental collectibles.
But I mean, I think the headline, regardless, I mean, the Trump headlines are not going to change. He is what he is. They are what they are. But it was a triumph of the bond market. And
the triumph of the bond market.
That would be the newspaper headline for tomorrow. If I'm running the Wall Street Journal, I run the bond market as a lead, and then the hope is that the bond market is so dominant that it reduces Trump and his merry band of fools to a distraction as opposed to a credible threat to the global economy. Because basically they're now penned in. I know I'm saying this the last minute of the show, but your best case is that the bond market has fenced them in and marginalized them to the fools that they are. And that as a result, the market may normalize. That would be the other sort of side of this whole thing.
God bless the bond vigilantes. With that, overtime is out of time for this Wednesday, April 9th, 2025. We'll be back tomorrow, same time, same place here on Tasty Live, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan, Milan, I've been Chris Vecchio in New York. Thanks for joining us again today. It's been a wild week. We'll catch you later. But stick around. Ilya is back. He's here for Macro Money coming up next on Tasty Live.
See you there, everybody.
If you missed the live show, here's our cherry on top weekly recap.
I had the what do you call the hot girls dinner?
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine.
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
This doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday.
Thank you.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense.
It does.
Yeah.
It really does.
That kind of tracks.
I don't even know what that means. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you
I'm thinking of getting rid of it.
new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh,
What is
I think you nailed it, Vanetta. I don't know.
No,
What is it?
cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom, platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
On the clothes.
Oh, it looked like it looked like a decrepit old grandmother. It was so gross.
It's like
Okay.
that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
I don't know how to do magic, but I do have a sense of how to use magic to steal money from the taxpayer. First, you need to take off anything that makes you look like a magician. That's key, Alex. The critical thing is to look like you're just a man in a suit trying to make a living. Goldman Sachs pulled off the amazing trick of making $3 billion in 3 months' time while the entire financial system collapses, foreclosures are at a record, and unemployment skyrockets, and the US dollar collapses. Shall we begin? The Facebook.com. Mark, if somebody was to put the question to you about the magnitude of what you think you've launched, how big do you think your product or your service is?
Well, it's impossible to tell.
You said something interesting, which is not within their economic means. I don't know that their economic means should take precedent over public interest. Welcome back. Here's a story to add to your bailout rage. It turns out we weren't told the entire truth about the banks. Honestly, you're probably not even hugely surprised by that. That's your plan for financial reform, printing presses and accounting fraud. And it's happening at the expense of you, me, and every future person in this country because of the money machine that the bankers have running to pay off our politicians. As long as you can risk as much money as you want and pay yourself for all the upside and stick the downside with the taxpayer, human nature will just leave them to screw everybody in America for as long as it's legal to do so. Remember, it got so bad in Egypt that there was a direct correlation between the growth in the GDP and the deterioration in the quality of life of the people because the people at the top were making their money at the expense of everybody else. It's connected. I'm not here to talk about plans to deal with this till 2017. I'm saying we've got a real problem, and I'm tired of Republicans and Democrats who either want Republicans who want to burn the place to the ground, and Democrats, with all due respect, who want to offer a plan that gets it through their end of their second term of their presidency.
and then screws me and my kids when it's over. And until we do that, we have to deal with the extraction that is at foot. It is the reason the financial markets are behaving the way they're behaving. That is a mathematical fact. This is not some opinion. This is a mathematical fact.
It was a great show. It was very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math was really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
Mystical reading of the tape. More trade ideas.
Sweet. Still can't believe the Wi-Fi we get up here.
The trade ideas on dough are as good and as true as my honored blade bid ask, with whose edge I gutted 100 marauding conformerons.
To the fearful bid ask.
With this blade, I pried open the gross, smelly lair of the Hydropons Hilda.
I remember that. You were covered in nasty snakes for like over an hour.
And don't forget how I used it to stab the snarling maw of the hideous Minotaur Dibitrix, his putrid breath filling my nostrils. But still, even with these thrilling conquests, these victories that have passed into myth across distant lands, I hereby deem the trade ideas on dough even more powerful.
Ah! I mean, you probably still need a sword.
Yeah. Didn't think that one through.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards, become a trading mastermind. Get the guide at tastylive.com/guide.
What a day this was. I'm sure most everyone has seen the headlines at this point, but man, do we have a tariff news update today. Markets rip higher as we get a stay of execution on the worst of the reciprocal tariff plan, or do we? That's where we find ourselves here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We're going to unpack what that was just now in the financial markets and take a look at what it might mean once the speculative dust settles and the spotlight turns back to what this story is really all about, the U.S. economy and what these tariffs might be expected to do and why the markets have been upset about them in the first place. We, of course, are going to get exactly that sort of a check on the environment as we get U.S. inflation data coming at us in less than 24 hours. So let's break this down. We started off this week talking about where the markets landed with last week's blistering sell-off. And we noted, as the week was getting started, that the markets stopped at a very auspicious spot. And that in this spot, you were probably, as the markets refused to break past it on Monday, you might see some kind of a recoiling because it seemed as though the news had not improved but the market had stopped selling. And indeed, right on cue, this ends up being a place where the markets turn. Let's zoom in here on the active contract for the S&P 500. This is the ES future for June, and this is the daily chart. This was a weekly one right here. So here we can see where we started the week and where we are today. Here we can see where we started the week and that stalling, that stop in the sell-off that we were just mentioning. And then, of course, today we rush back higher. No, we stop right at the underside of the preceding leg down. So just at the spot where we get Liberation Day. That's this right here. This is where the sell-off really garners steam last week. And here's the preceding leg of the initial decline, where we find a little bit of a reprieve before Liberation Day, when, of course, the tariff plan is unveiled, and the market clearly has a hard time digesting it. So, what to make of all of this? Well, the rally comes as the president comes out and says that reciprocal tariffs, which were supposed to get introduced today, into practice with all of their varied rates across many economies, will not, in fact, go forward as such. It will go forward, but only with a baseline 10% tariff rate for all trading partners. But China, since it has already retaliated to the president's actions, will instead face a 125% tariff, which is an increase, and at this point, these numbers are hovering somewhere in the realm of the mythological. At this point, we might as well say it'll be a 500% tariff, or a tariff rate of a bajillion and one. It looks very much like now the stage is being massaged to some kind of negotiation, and clearly those countries that didn't retaliate, it is being shown, see reprieves occur. And so the upshot is that the tariff threat has been watered down some, but more importantly, that the amount of consternation in markets has been enough that there is, in fact, a reaction function from the White House. We've heard all through this decline last week and going into this week that the weakness in the stock market was going to be overlooked, that this was par for the course for implementing this new policy, and that the dust would settle and things would be okay. Today, we see that the level of pain grew too much, and we get a step back that ultimately speculative interest likes very much. And so we get this dramatic rally, and that makes sense. But where does this leave us? Well, the place where this move lands seems very appropriate to start that discussion. Again, we land not with a new high, but with a volatile reversal that nevertheless leaves the breakdown intact. We retest the underside of the preceding range. We fail to make it over. Does that mean we won't make it over necessarily? Well, of course not. But what we still see here is a trend lower. Lower lows, lower highs. And then we start to consider the upshot. Why didn't the markets sell off on tariff news in November when they knew that some sort of tariff regime was coming? That was here. Markets were not upset here. Why not? Because it's not the tariffs they're upset about. It is the uncertainty with which fiscal policy, as epitomized by the tariffs, has been put forward. And so it is not until mid-February, late February, when business confidence surveys like the PMIs, consumer confidence surveys like the one from the University of Michigan and the one from the Conference Board start showing that all of this policy uncertainty is starting to end up with lower economic growth expectations, weaker sentiment, and decelerating growth. It is not until then that the markets start to care, which is here. And so it is the uncertainty of execution that really seems to bother investors, not the trajectory of the policy goal as such. And so with that in mind, we look at what today's announcement brought, and it was another U-turn in a policy that looks no more predictable now than it did yesterday. Moreover, what we find is that we still have the same basic architecture of the economy before or after this. Consider, this is the GDP Nowcast from the Atlanta Fed. And again, as we've said a lot here on the show, it's not about the level. It's not about whether the economy shrinks somewhere between 0 and 1% if you discount the impact of gold imports recently, or between 2 and 3% if you don't discount them. That's not really what's important here. These nowcasts take in information sometimes daily, sometimes every several days, depending on when the economic data comes out. We will surely have an update after this incoming batch of data this week, but it's not the absolute levels that matter. Those will change as that data is factored into the model. It is the direction of the data. And we can see here clearly from February, about the middle of February, right here, the data begins to aggressively deteriorate to show not that the tariff policy is negatively impacting things, but that uncertainty about fiscal policy, including tariffs, is putting a dampener on economic activity. And that's why the sell-off kicks off here and not earlier. And with today's announcement, that uncertainty has not been in any way relieved. Consider what happened on Liberation Day itself and this upward wick on the S&P. Why does that happen? Because initially, when the president comes into the Rose Garden and says we're going to have a 10% broad tariff, market actually likes it. It is not until he comes up with the foam board with the multitude disparate rates country by country that things become not to investors' liking. Because if there is a blanket tariff, well, then at least it's forecastable. And that's all that the markets seem to want. A runway and a pathway for businesses to follow, whereby uncertainty can unclench, whatever the outcome. But that is not what we have here. What we have is another sort of situation where we seem to be moving the goalposts frequently, and businesses and consumers are going to have a hard time extrapolating forward. And of course, by extension, likewise, the markets. And so once the dust settles on the speculative element of this, we are left with this. An economy that has started to significantly decelerate because of uncertainty. And while policy expectations have meaningfully unclenched as well, as of yesterday, the first rate cut was already on the menu for May. It is now back out to about July to be fully discounted. Moreover, the amount of rate cuts has significantly come down. But if we actually look at the total tally, we can see here yesterday into today, it is barely changed. In fact, it's been barely changed for about a week, where the markets are looking for essentially 5 rate cuts with some room for error to the dovish side between now and the end of next year. What's changed is that yesterday and the day before and toward the end of last week, the markets saw many more rate cuts coming in 2025, 4 of them, and maybe between 1 and 2 next year. Whereas now we have 3 coming this year, so 1 less, and 2 with some optionality for a 3rd next year. In other words, all the markets have done as a consequence of this announcement is take 4 rate cuts for this year and 2 for next. 1 and 2, let's say. And moved the cut back by a year. And said it's not 4 this year, it's 3. It's not 2 or 3 next year. It's 1 or 2. And so the makeup has ostensibly moved to a somewhat less urgent setting. But the upshot that we need 125 plus basis points, 125 basis points would be 5 cuts, and again, with a little bit of optionality for a 6th. That's what we need, whether you sequence it this way or that. But the total has largely remained unchanged, and most importantly, that total is greater than what the Fed has in mind. The Fed forecasted in December and then reaffirmed at its latest meeting in March from 4.4 on the headline rate down to 3.9 this year. That's 50 basis points. Out to 3.4 the following year. That's another 50 basis points. That's 100 basis points between now and the end of next year. The markets are obviously 1 rate hike or 1 rate cut and some change to the dovish side of that. And that has not been altered. It's just now the markets see more cuts later versus sooner. Moreover, when we get the minutes from that March meeting today, amid all of the uncertainty and amid all of the swings back and forth in stock markets around the president's announcement, what we find is that the mood for policymakers in March mainly was a troubled concern with inflation. We have here growing concern about inflation persistence amid trade policy uncertainty. Almost all participants viewed risks tilted to the upside for inflation and down for employment, with the outlook for real GDP growth weaker than January. And of course, participants linked all of this and said participants observed that the inflationary effects from tariffs could be more persistent than projected. In other words, the inaction we've had from Fed officials around all of this speaks to their concern that the tariffs might be bigger and stickier in their upward in their upward impetus on price than they were anticipating. But of course, the markets have taken it a step further. What those Fed minutes tell us is they tell us what the Fed was concerned about and why they are not cutting rates, or at least signaling that they're ready. But what the markets are saying is that the hit to growth from these tariffs will be so great that their impact will be disinflationary. That is to say, the tariffs will raise consumer prices such that consumption takes a hit, investment takes a hit, growth overall is dragged lower, and the hit to demand is so severe that inflation actually goes down because whatever uplift from the tariffs is more than overwhelmed by the pull that weak demand and recession have going the other way. And so if the Fed minutes establish for us why the Fed isn't cutting as of March 19th, this collapse in break-even rates since early April is telling us the Fed's wall of worry need not be there, because the market is telling them that inflation expectations as a consequence of this are going down and not up. With that, of course, the incoming inflation report becomes absolutely critical. We're expected to see a downtick, 2.6% on the headline figure and 3% on the core. For the headline, that would be the lowest since October. For the core, that'd be the first time we see a 3% at the figure reading there since April 2021. So this is significant disinflation being signaled here. Moreover, if we look at the dynamics and the trends that the Fed likes to watch here, we can see that if we get another downtick, it would mark a third consecutive month after January and February that the trend in annualizing 3-month and 6-month changes in CPI might imply. So we see here the sort of internal dynamics of where inflation is going. What the Fed likes to do is take the 3-month change and annualize it, both for the headline and the core, and kind of get a sense of the dynamics. And what we see here is for 2 months now, the annualized 3-month rate, headline and core, lower. 6-month rate, core, lower. Headline 6-month looks about the same, but certainly not rising. In other words, at the start of this year, we start to see inflation begin to roll over downward, and this would be a third consecutive month of seeing that, even, again, as these break-even rates are telling us the inflation scare is leading to lower inflation expectations as a consequence of the tariffs, not the other way around. So the barriers to the Fed moving from here, 100 basis points, to here, a more dovish setting where the market is pulling them, might well be breaking down. And if we were to get a CPI report that endorses that, we might certainly see evidence as much. Now, of course, what that would imply, as we've seen over the recent months, is that the economic hit is already underway, hence the disinflation. We've seen that it has come mainly over the past several months at the expense of core services, which is where growth has been and what has led to the U.S. economy outperforming as well as it did last year. And so the upshot here may well be that this rally, while certainly a breath of relief for sentiment, is only that. And what it is an opportunity to get back short, looking for a more orderly move like this to reflect the economic reality of what's occurring, because that hasn't changed, even though the sentiment piece might have become less vicious. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back in just 30 minutes time here for the Price of Truth with Victor Jones. I'm back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sunday. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.
I distinctly remember getting an email from Tasty that look-back had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on tastylive with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from tastylive to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Here's what your buddies mean when they say to catch a falling knife. Ever seen a stock make a huge move lower, and maybe you had the thought, I'm gonna buy that stock, but then it just keeps going down? That's a falling knife. A falling knife is a stock that makes a big move lower and then continues to move lower. The contrarian trader has the idea to go long that stock in the hopes for a bounce, catching that falling knife. But you gotta be careful trying to catch those falling knives. Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately has turned into 100 shares of long or short stuff.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, of course, Dan Cecilia. And keeping with the trend, Dan, it's Wednesday interview series. So we've been talking to traders recently off of X. We have no stranger to Tasty Crypto. We've done some spaces with him on X before. We got Boss Imp of Strike here today. Boss, welcome to the show.
Thank you, Ryan. Happy to be here. Looking forward to the discussion. I think the market have been exciting, and we have a lot to talk about today.
Yeah, absolutely. Keeping us on our toes. I think everybody probably assumed you'd get some sort of rally, a big bounce at some point in time. Last week has been challenging, I think, to say the least, not just in crypto, but across equities and many different markets. Feeling the pain and volatility at levels that we really haven't seen all that often in history, which makes it fun from a trading perspective for sure. We're going to talk alpha opportunities, on-chain options, your journey a little bit. I think you've got a really interesting story here that I want to dig into. But before we do that, let's just get right into it. How are you thinking about the markets at this stage?
Honestly, today I was talking like in Telegram, and I was saying I was expecting a rally either this week or next week, because for me it was kind of a bluff. Not a bluff, but like leverage this whole rally, this whole tariff discussion. What's coming is a bit more... It's a bit more of the surprise. We're going to see a rally on equities to some extent. They've been oversold for crypto. It's another story. We've been seeing like a lot of BTC dominance keeping strong, what's gonna be like the risk appetite of with the ETF, with the institution in the US notably. We have been all a bit disappointed with what came after Trump, price action wise, but there have been in the background a lot of improvement. And I don't know, personally, I've been seeing a lot of people saying, bring Gensler back, etc. But I think they don't see how the regulation is moving and we're getting an adequate regulatory framework. There is a lot of lawsuits that were dropped. There were nonsense that were dropped. We're going to get like a really nice sandbox to potentially play. And it's the moment for builders to come and to build and to get us like those new use cases and to integrate them and to take potentially crypto to mass adoption. So we should be excited about that, not just about price action. It's more about like the whole like environment and how with the adequate policy we can push crypto overall.
Yeah, that's what I'm interested in myself, is just to see how this evolves. You know, do you get this kind of DeFi renaissance or DeFi 2.0 given a shifting regulatory backdrop? But in no way am I advocating for bring Gensler back. I have not seen that, but that made me chuckle.
No, I've seen it
bit.
in groups. It's memes, but people are really like traumatized by the recent price action.
Did you expect the move today? Did you expect kind of this pause or this like relief that we saw today? How were you positioned for it?
I wasn't expecting it today necessarily. Like last week, I think Friday, I bought some butterfly for Monday and for Friday. And the Monday one I sold at a small loss. And the one for Friday was I think it was on QQQ. It was 450, 460, 470 butterfly, and now QQQ shot to 467, I think, something like that. So I closed that one and I opened the one a little bit higher because I think the move is gonna continue. But yeah, I was expecting. So I was positioning for this explosive rally, especially after what happened yesterday. I knew like the moment we were gonna get a relief, we're gonna get harder. I wasn't expecting it today. I wanted to buy spreads and to get exposure to that if we went a little bit more down. I was waiting a bit. I was as the week passed, I was most thinking next week. But yeah, you never know, and it happened today. So, but I expect continuation, so I positioned a bit for it, but we'll see.
Yeah, I would think the same. I mean, after just the size of the move here today, obviously volatility is still a bit elevated. Maybe we see some follow through. Don't necessarily think we're out of the woods just yet. I mean, we got a 90-day pause, and I think the big relief is obviously on the back of reciprocal tariffs across the board going to 10% versus some of the higher numbers that we saw on that big, I don't know what you call it, flashcard or poster that was displayed on Liberation Day. But there's still the 125% increase, or the increase to the rate of 125% now on China. So we'll see how they respond.
But that's something to put it in perspective. The US, I think, imports around 440 billion from China and they export 120 billion. So I think like that's kind of unbalanced, and if they cannot just retaliate with tariff, they need to negotiate. And once those supply chain move from China, they're sticky. They won't come back to China necessarily as fast as and giving how Trump, like President Trump, focus is against China, some country may move from China for like, I don't know, Vietnam or Philippines or whatever and don't come back. So China has to be afraid of that, I think.
Yeah, absolutely. I think you probably have a scenario where the U.S. likely has the upper hand here. But want to switch gears. Dan told me earlier today that he saw on Twitter that you had mentioned you took a wallet from, let's say, around 1 ETH to some pretty sizable gains. Everyone should go and follow you on X, first of all, or on Twitter, whatever we call it nowadays, at BossImp75, up there on the screen. But can you talk us through, I mean, you don't have to give us all the details, obviously, but can you talk us through how you did that? How does one in crypto, where you can have sizable gains, obviously, but kind of any approach that you took that was able to get you to those levels? Can you shed some light on that?
Over risk and hope everything goes right. No, but like for that specific wallet, it was the one wallet. Like I aped into some Google form project. I did a fresh wallet with 1 ETH, and it kind of 3x'd it, I think, or 5x'd it. I don't remember. It was back in April or March 2024, and I kept using that wallet, and I kept like, it was when it was the 404 meta, like those NFT mixed with liquidity, and I kept just buying that meta, buying the dips, making 50%, 2x on some dips when like. Honestly, this year on chain, if you do DGM stuff, it means high risk, following the meta. We had a few meta this year. I'm not talking about Solana because I suck on Solana, but I'm talking about like Base, ETH, all the EVM chains. If you had like 2 months this year or 3 months, it would be like March 2024 and November and December 2024. You trade only when there is like high liquidity, high volume, and you have a clear kind of meta on chain, and you just grind the groups, you grind Twitter, you try to get into like early into some projects, either early and you can get those big multiples, I don't know, 5, 7, 10x sometimes, or you get into those heated meta when you can buy the dip and hope for a 2.5x, 3x, and really don't like watch the volume, and you don't want to be a bag holder. So sometimes you exit early. If you don't feel it, you exit early. You kind of protect your profit. And on the other side, sometimes there is another strategy that I used to some extent is you be patient. There is a lot of, if you find a project you believe in quality-wise, sometimes needs time to, like, for liquidity to redistribute, for people to exit, etc. But I've done a couple of projects that they did 10x. All I had to do is wait 1-2 months, but you have to identify quality and to know like the right parameters for that. So don't over risk. Try to trade when there is a lot of liquidity around. So for example, lately I've not been trading at all on chain because I think you're more likely to give up gains. So you trade when the market is moving, when there is a lot of liquidity, when there is like easier to make multiples. And then now I've been trading a bit majors, and I'm going a little bit more on equity because equity is like, majors are now behaving on equity, like behaving like shit coins, basically going up 12% daily. So yeah, I think it's just you have to choose your moment and to get into those groups, to get into the follow the meta and follow the liquidity.
Yeah, and on that point, you talk about like getting in early projects or just like following the meta. Is there anything specifically you do follow? Like, where do you find alpha?
So before it used to be Discord, I was in a few groups and I would like try to get, now I moved to Telegram and I don't like this. Usually like I'm a boomer, so I kind of have sometimes trouble to adapt to change, but it took me like a few months to get into Telegram bots. Now I've been tracking a little, also some wallets, so mainly Telegram, tracking some wallets, doing some DD. If I see like multiple wallets I'm following, buying something, I would kind of DD it a bit more, or it's basically being present. And also in some groups, I tried like over years, I met some people, introduced into some groups. Some are paid groups when you have to have an NFT. Some are free groups, and I try to like to continue the grind and to get into as many. One of my problem is getting information. It's not analyzing information. It's how I get the information. It's always been difficult for me to go to grind Twitter, etc. So I use groups and wallets as proxy for information. Some people are better than me to find information, and I try to exchange that with more knowledge around the markets, around risk management, etc. So they have win-win. Giving me like access to some groups or giving me information.
So when you find a wallet that's, I guess you're following a wallet, let's say, and is it simple as they purchased a token, they're getting into something, and that kind of pops up on your radar, you start to investigate it or explore it a little bit more?
Yeah, something like that. And especially if you have like multiple wallets you're following that buying, that's a stronger signal. But sometimes you're gonna have a wallet that's just buying something kind of random, and you don't have information on it, so you cannot like you can autocopy in theory, but sometimes it's not worth it to autocopy.
Yeah. So, sorry, go ahead.
Especially in times like this, like if we were like in November, I would be a little bit more loose, but right now I'm just very picky about what I buy.
Gotcha. And so switching gears to Strike, you're listed as an advisor there, and you're pretty, you're part of the team. Can you tell us, a little bit more about it and, what you've been responsible for there?
Sure. So Strike was originally DOPEX. It was launched in June 2021. I actually participated in the public sale of DOPEX back then. I was just starting in DeFi, like a couple of months ago. So Strike is a decentralized option protocol. Now we are using concentrated liquidity to sell options basically on the CLAM model. So using concentrated liquidity AMM, we can sell options on any assets as long as it has a V3 liquidity pool and people to provide this liquidity. What is smart about this is, as a liquidity provider, we can optimize your yield by using by selling, by like we kind of cut or like use your whole range to sell options, not only the active part of your range. When you provide liquidity on Uniswap, I don't know, you can provide between how much is this 1.6, you can provide between 1.4 and, or let's say 1.5 and 1.7. You will have only a portion of your liquidity that is active. When you provide liquidity to Strike, you can sell options on your whole range and optimize your yield that way. We were present on multiple blockchain, Arbitrum, Bera Chain, Sonic, etc. And we're looking to cover assets that are not covered by like big exchange like Deribit and etc. And also we cover ETH and BTC. And my role on Strike, I'm more an advisor on quantitative matters, and a bit of strategy. I was very involved. I was following the project since 2021, and I became friend with the team. And we felt at one point like my input was valued, and I was to be like participate in product design and work into really quantitative issue. My background is in investment banking and risk management. I worked on interest rate derivatives. I worked on options professionally on equities with risk management optimization software, which had hedge funds and market makers as clients.
So when you look at on-chain options, is there a specific chain where you're starting to see more signs of growth or a concentration of liquidity, or what, I guess generally speaking, are you seeing in terms of the maturation of the markets?
Sadly, on-chain options have not really took off until now. I think it has to be something that I've been advocate for a long time. It's capital efficiency, how you can sell options where being capital efficient and having some kind of this margin on chain. And I think something a lot of options protocol are not exploring is potentially how to get that capital efficiency and also how to reduce fees also. For example, I would like to see a Deribit competitor, something like Hyperliquid, a Deribit competitor that has lower fees. I've been dying to try some sophisticated strategy on BTC, on ETH, but the fees are killing me on Deribit. It's 3 bips, I think, 3 or 2 bips, so it's 0.03%, and it's huge on BTC. For me to be profitable, as if I open a butterfly, I'm instantly down 20-25%. And that completely kills my risk reward.
Yeah, absolutely. It's tough when it's that wide or the fees are that high, in a sense. For anybody that's not familiar with on-chain options, though, I mean, is it fair to say that it's very similar to the experience that you might have? And granted, there's maybe a little bit less liquidity at times, and I think that will improve as we go forward. But is it fair to say that it's very similar to the experience that you would have with, say, a Tasty Trade or trading options as a retail participant through a brokerage firm? Do you have an option chain? Can you use similar strategies regardless of the capital efficiency? Is there still a way to approach the markets that way?
So for Strike itself, you can only go long options via buying them or provide liquidity. You cannot do at the moment selling like spreads or butterfly. You can on some other exchange do it, but the margin, to my knowledge, is not very well calculated and the liquidity is not present. The advantage of Strike is since you can only go long options, you have a small discount compared to what you would have on Deribit, for example, or etc. So you're gonna get that because it's a win-win situation when liquidity provider get a higher yield, but since they guarantee the payoff only if you are in the money, you get a discount. So for you, if you want to like swing and to get like this big leverage at a small discount and you kind of bullish in 24 hours or 1 week, that's the two maturity we have. You can do it. On chain, honestly, for me, liquidity has been very, very problematic whenever I use. So I use Strike because it's a mid price. Whenever I use other platform, I'm gonna move the mid price, or I'm gonna get like this margin problem. So I'd rather use, for example, Deribit or Bybit, even if I'm not a fan of their liquidity. I think the liquidity has to scale, and it's hard because we need to get like some market makers, and the problem there is not liquidity, so market makers are not coming. So that's why we need like kind of a big push on options on chain to get like a sex-like experience on chain.
Yeah, I kind of think that will probably, I mean, we sit in the US, so we have a bit of a US centric approach, but should we get regulations over time that I think influence activity on chain, that probably has to happen first, but I think it will happen, which I'm excited about. And that's probably another indication of how early it is too, that you don't really have a robust or mature derivatives market in this space. As you've mentioned, there's Deribit, but it's kind of it. So I think, again, another sign that it's early, and while it can be frustrating at times if there's less liquidity, I'm excited about the future.
I'm hoping because I want to see like this option sector like expanding. It's been only retracting since early 2023, so it's a bit painful to see. We used to have a lot more activity even on chain. I think it has also to come with people understanding perps easier, and options are a bit more complicated. I think the real boom in the US came from retail and from Wall Street bets, and we kind of have that, hopefully, that moment for crypto options at one point. And talking about Deribit, I think Coinbase put a bit on Deribit lately, so that's kind of interesting.
Yeah, that would be really interesting if that plays out.
Yeah, do you have any thoughts on that? Yeah. Like, do you think that's a good thing for the space, that consolidation or Coinbase acquiring?
Yeah. I think like if you can get for me, I'm frustrated with the overall option market, even on derivatives. I need to check. By the way, today, if option ETF has been approved, so I want to check the liquidity on that. I think on IBIT it's really good. I need to check on that. Maybe I'll do a little bit more options. But yeah, I think it's a good thing if Coinbase basically since early this year have been taking more risks. And I think they're going to push for being really the flagship of crypto in the US, and have them having options and pushing them to retail should impact also on-chain options, but should impact the liquidity. Maybe the fees also get more actors, be able to do all what we can do on a regular broker on Deribit. That would be very, very nice to me, honestly.
Yeah, just to that point, boss, like you mentioned, coming across the wire here, it looks like 30 minutes or so ago, SEC clears Ethereum ETF options trading for BlackRock and Fidelity ETFs. That got lost somewhere along the way, given everything else that was going on today. But that's huge. That's really exciting. And again, is another step towards, I just think, again, the evolution of this space.
Yeah, definitely. Now we're waiting for staking on ETH ETF, I think, and that would push a bit ETH price higher and get like some traction from boomer that want that 3 or 4% dividend yield on their ETF. Or
Absolutely, yeah. And I think it's great to point that out because, we look at kind of the short-term volatility, and as you mentioned earlier, there was a lot of excitement built into kind of the post-election price action and the assumption that we were going to see immediate changes, which nothing ever happens overnight like that. But when you look at kind of the roadmap, or you look at maybe what's on the horizon, in a sense, again, a lot of indications that it's still early, right? We don't have Ethereum ETF staking. We don't even have a Solana ETF. And I'm not saying that you need an ETF wrapper for all of these different tokens, but a couple more catalysts that likely sit on the horizon that could certainly induce flows for sure.
For me, I think it's how we see the future and how potentially the newcomers what the newcomers will buy. After like BTC, ETH, Solana is a certainty for me to some extent. Who will win between ETH and Solana? I think they're not really competitors. They're like serve different audiences. But after that, what will stay? What will consolidate? What will emerge? That's the big unknown for me. For example, we can see a development of BTC DeFi. What's going to be the big trend? What's going to be the winners of the Trump administration? That's the big question, and that's something to be looking forward and to try to find it and to place the bets pretty early.
Yeah. Do you have a view on that? Is there anything that you're looking at that you think might be a winner?
Potentially BTC DeFi, maybe, but honestly, I don't know a lot about it. I need to look a little bit more about it. Something like everything that is BTC centric seems like a good narrative, and I need to do more research about it. And to like this year, I've been trading a lot. I've not been like researching a lot. Now I think it's the moment to take some time and to try to figure out and to be on top of the new meta, or like the new narratives, I would say.
Yeah, make sure you share that with us when you figure it out, though.
Absolutely.
Will do.
Yeah, so we always ask our guests, do you have a bull prediction for Bitcoin or crypto broadly over the next year?
I think Bitcoin is easily go to 150K in the next year or something. I won't say 200K. But that's on the table. But I think Bitcoin is very well positioned. When you see, even compared to like traditional market, it held very, very well. Like I think it outperformed Nasdaq on this drop, almost outperformed Nasdaq from all-time high drop. So I think like Bitcoin is very, very solid, and it should at least go to 150K by mid 2026.
Music to my ears. Yeah. I mean, when you just look at the chart here, it does seem that there's a similar pattern forming to what we saw for, most of, let's call it the March to pre-election cycle there, or that period. And then you had the election catalyst, obviously, and you shot higher. Well, you're kind of seeing a similar, I don't know if you'd want to call it a fractal pattern, but you're kind of seeing a similar trend in place here. And I think if we can just base around 75, 80, that's encouraging, to say the least.
And we've been distributing a lot of market cap, like even the increase from 65 to 110 was very, very fast. And that's adding, I don't know, how many, 500 billion or something, 600 billion of market cap. So it needs to kind of solidify and like distribute and get ready for the next. I think if we made the bottom right now, it's very bullish for Bitcoin, I think.
Absolutely. Well, before we let you go, one last question for you. Any advice for new crypto traders or investors, given you've been in the space for a long time, you got a lot of experience and you've had a lot of success?
I think wait for when the moment, like how I was saying earlier, trade when the market is really moving and is really positive. Like usually there is a lag between price action for majors, BTC and ETH, and how the on-chain activity goes up. So when the on-chain activity ticks up, you can try on-chain and you can try to understand how things move. Don't over-risk initially, but what's interesting about on-chain is the asymmetry of risk. Is you can lose only 100% of your initial, but you can make multiple x, 2, 3, 4, 5x. So once you get the feel of it, try to get your risk on check and to not over-risk. You don't need to over-risk to make money. But yeah, trade when the market is good, and don't try to overtrade when the market is like turning bad or going down or there is less activity. And don't greed, don't it's better to exit before the top than to hold on the way down, and there is enough opportunity for you to make money, basically. But just take time to learn, and it's not gonna be a quick dollar, but if you take time, you can potentially hit it big.
Awesome. Well, boss, we appreciate the advice. We appreciate you coming on the show, and hope everybody enjoyed this interview. Definitely head over to X. Give Boss Imp a follow on X at BossImp75, an advisor to Strike. A lot of good content on his feed. So check him out. Hope to have you back on here as well at some point. Want to do a round table. We've had a lot of traders on the show, a lot of people with a focus in the derivative space. So would love to get you back on here at some point as well, boss.
Anytime. Honestly, anytime. Thanks for the discussion, guys. I hope I didn't talk too much, and it was a pleasure, Ryan and Dan.
You're great. Yeah, thank you very much, and we'll talk to you soon. And that's going to do it for our show. We will be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
Explain pot odds.
Pot odds is my favorite term, but pot odds in the poker world or gambling world refers to having a greater payout than your implied odds would suggest. So let's say I have 3-to-1 odds to win a pot, but the pot is giving me 4-to-1 odds to make that bet. I would have a positive expected value over time. So in trading, let's say you have a defined risk debit or credit spread that's currently at a max loss, and let's say there's 30 days left to go. There's not really a reason to close that position because you're already at max loss. You can only go up from there. So in that scenario, that would be a positive pot odds scenario, or something that would give us pot odds to stay in.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. Oh, good. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive? Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh, my God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11?
Oh.
First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Move with the rhythm, shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Oh, yeah. Tasty Nation, good morning.
You know you need it.
stock goes down, so what? Because now you're long the stock and at a better price. Oh my God.
Hello, everyone. Welcome to the Liz and Jenny show.
Jenny, I think if this show doesn't pan out, which it might not after the show, I don't know if you know this or not, this might be our last day on the network. I'm pretty sure this is our last day on the network, so Jenny will be taking her act on the road as a ventriloquist.
Puppeteer.
So my job is just going to be the evil villain sitting next to her.
Got an idea. Crystal ball, where is Ford going to be?
Does it talk to you? How do you get your messages?
It comes right to my head. Still working to manage my far in the money put in my Namasaki's company.
Namesakes.
Honestly, the SPXs burned me once, shame on you. Burned me twice, shame on me. Burn me. What?
When somebody says tape action, what do you think of?
To me, tape action is a little bit of a historical term because that's how they used to relay the different information for all the different underlyings that you could trade. They would share like the price, the volume. So it'd be a way for people to kind of get a gauge for different markets. But now I just kind of think of it as that little line of information on your screen when you're watching your financial news outlets and seeing what all the different products are currently trading for.
What's a Johnny trader?
A Johnny trader is defined as Nick Batista and myself. We are smaller traders, smaller accounts, mid-sized accounts where we can't sling anything we want. We can't do multiple contracts of anything we want. We are really defined to specific parameters in trading in a small way. So a Johnny trader is just someone that might be doing one lots, one contract here and there, or trading smaller price products.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options backtesting for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get backtesting at Tasty Trade.
Wolf! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Christy Ross, St. Norbert College, Wisconsin. Number 85, because I like trades that have an 85% probability of success.
Lindsay Grata, University of Illinois, Chicago. Number 14, because that's how many times Tom asked me, where's my lunch?
Tom Sosnoff, State University of New York, Albany. Number 0, really? You gave me 0 because I like being delta neutral?
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
All right. Perfect. I would like to buy Park Place.
No,
What?
there is no Park Place in this game.
Yes, there is. I'm looking at it.
No,
I
this
will
is mine.
take
It's
it.
mine. You don't get it.
Okay, alrighty.
You know what? $500. $500 to the electric company if you want to keep all of your power on all these houses and hotels. And
You can't negotiate. I landed on it. I can buy it if I want
I'm
it.
the electric company. I'm the most powerful thing here.
Excuse me, to the person who owns one property on Monopoly. This is the mayor, and I am overturning everything, and
You're
I am
in over
allowed
your
to buy.
head.
Excuse me?
You're in over your cute little head.
Don't patron.
With the railroads. And what do you just have? You have a bunch of hotels and houses, which in this market is ridiculous. A nice, simple house on Mediterranean Avenue. A beautiful car worth 10 times more than your dog who is gone. Cut a deal with me. Come on.
Okay, I quit. If you're gonna be an asshole, I quit.
Then I win. The old bait and switch. I got you. I told you I'd never lose this game. I've always got a plan. And you fell for it. Boom! Shalaka!
Oh, yeah, it's Wednesday, April 9th, a little bit after 5 p.m. Central Time, the best time. Thanks for your patience solving a little internet issue on my end. You know what that means. It's time for The Price of Truth, a little show where we like to explore the incentives that govern our world. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of this little chat box in the middle of your screen, there's only one place to do it. Head on over to Tasty Live's YouTube channel and jump into the chat. I'd love to shout out everybody in the chat, but my friends, we've got work to do. And with us today on this wacky Wednesday is the big brain, my friends, and it's going to take a big brain to digest the events of today and the price action of today. More importantly, start to think through what to expect going forward. I'm talking, of course, the global head of macro here at Tasty Live, the one, the only, the incomparable, Mr. Ilya Spivak. Ilya, how are you, my friend?
I should get that kind of an intro all the time. That would be great. Anytime I walk into a room, just the euphemisms keep going. I can get used to this. It's been a great day.
I'll open up a Cameo account. I'll do that for like 40 a pop. You just put in a few shekels into the vending machine, and now I'll shoot you over something you can play every time you walk into a room.
I'll just walk around with one of those old school boom boxes on my shoulder and just hit the cue when I come in.
See, the problem with Cameo, now that I think about it, didn't AI just kill that whole business? You know what I mean? You can just get Morgan Freeman's voice. You don't really need to pay Morgan Freeman.
You could get Morgan Freeman video if you really wanted to.
Yeah, bro. Well, it is great to have you, Ilya, and we got a lot of work to do today. S&P 500, my friend, 5510. Who'd have thought?
Yeah.
NASDAQ at 19.3, the Dow Jones over 41,000, and the Russell at 1936. Let me say this to start off the show. What I find fascinating is there are two different realities. There are two different perspectives of the world right now, and of the events that just took place today. And I find it fascinating that we likely, I'm just going to take a guess, I think we likely saw the same thing. I'm not sure if we perceived it the same way. And what I'm most interested to do is go through the perceptions of what happens and how that sort of changes what you and I think about the future. I'm delighted to have this conversation. Ilya Spivak, walk me through the price action, walk me through the events of today that obviously impacted the 90-day pause on those that did not retaliate, how that you think impacted price and where we go from here.
Well, I mean, it doesn't take a genius to look at a chart of the S&P 500 here and say that the markets liked it. This was the biggest rally, and I'll give you this reference point to the day. This is the biggest one-day rally in the S&P 500 since March 24th, 2020. That was the first big rally, the first day of the rally off the COVID low. So March 23rd was the COVID low. March 24th was the first big up move in what would be the 2-year rally, basically, that followed, going into the start of the rate hike cycle in 2022. So massive day, obviously. The markets loved it, obviously. There was a tremendous amount of consternation starting from this week, especially in the bond market. I'm sure we'll get to that in due time, but clearly tremendous consternation in markets coming out of the tariff announcement last week. For my part, I was looking at stocks at the start of this week, and in particular on Monday, saying they're not selling off anymore. And you can see that there was a big, scary open. We were talking about it on Sunday. Big, scary open is, and we were saying on first call then, Asia hadn't taken a crack yet at what Wall Street did on Friday. And what it did on Friday was basically sing a swan song. So there was going to be a bad open. And so it was. In fact, it was worse than any of us expected. But ultimately on Monday, things didn't sell off. And I didn't think the news flow got any better or any worse. I don't think it changed at all. But the markets stopped selling. And I took that as a sign saying, well, if the news flow isn't going to improve, I'm going to be a seller of vol here. And so I just started selling put spreads in SPY and in the Qs. After today's rally, I'm out. Because I think this might be all the rally that this market has in it. Because when you look at the substance of what came out today, it no doubt relieved speculative sentiment. I mean, it's right there on the screen. And I don't think it's the substance of the announcement that did it. It's that the president and the administration more broadly were shown to have some level of response to market signaling when that market signaling got dire enough, and first and foremost to bond market signaling, because it really took that going haywire over the past 24 hours for the administration to really respond. But I think it showed markets and speculative sentiment in particular that there is a pain point, there is a reaction function. Things are not just going to be allowed to fall away. I think that's very obviously good news, and it makes sense why the markets liked it. I also think, based on what we talked about before, if the markets were afraid of tariffs, they would have freaked out on them in November. And they did not. They started to freak out in February because the uncertainty began to show up in economic data as a dampener on activity. It showed up in business confidence numbers for several months straight. It showed up in consumer confidence numbers for several months straight. That's why the sell-off begins where it begins. The markets aren't afraid of tariffs. They're afraid of a growth slowdown. And once they saw the slowdown, whether you believe it's really because businesses always wanted to retrench on activity and they're using the tariffs as an excuse, or they're not, that doesn't matter. What matters is businesses started to retrench on activity, and so did consumers. And so you have the growth scare is the thing that matters. And the uncertainty that is implied in that growth scare was not at all relieved today. In fact, it was reinforced because we have another fast reversal on policy, and we once again see that policy operates at a whim. And so there is no forecastability to it. Even on Liberation Day itself, when the president first said it's a 10% blanket tariff, markets rallied because they had certainty. And then the foam board came out and they freaked out and saw that no, this isn't a 10% blanket tariff. It's a baseline. So I think that the markets don't have any of their issues solved but for a speculative relief day, and that everything else remains as bearish as ever. So I got out of my longs today. I'll be looking to sell before long.
Wow, there's a lot there. That was a terrific way to start us off the show. As always, man, I shake your hand. I want to acknowledge a couple things you said and then maybe unpack some of them, maybe challenge a few of them. But I agree with you that the 10%, the market rallied. I had argued, I think a lot of people's notes in the street that like the expectation was 10%. So I had argued the 10% tariff was already built into market pricing. So if the worst thing you got was the thing you already expected, you're off to the races to the upside. So yes, I agree with you. And I think that's more to do with the market had already priced it. Agreed. Number two is, you said two other things I want to either unpack or challenge. One, that what is happening is on a whim. I think that's the most interesting part of the perspective difference that you and I are going to have about what's happening right now. And I want to unpack that a little bit. But before I get there, I'm going to set that to the side. And then you said that the volatility was not tariffs, and it was not tariffs. It was the growth slowdown. I would agree with you. You and I both have acknowledged, I think, for a long time that there was a growth slowdown happening that the market or prices hadn't seemed to acknowledge. We're now in a period, and we got to a period where you got a catalyst that you had to acknowledge it. However, I would challenge, you and I had a conversation, it might have been last week or it might have been the week before, where you explicitly said, I thought, and I'm not trying to catch you in logic, I just want to understand your perspective, that you had felt the market was reacting to an erratic administration, that you felt like the manner in which these negotiations or the tactics that were being chosen in these negotiations, that was the market was saying, I don't like this, I'm reacting to that. So can you help me understand what's the difference between you saying today, and I'm sure there is nuance because there always is with you, what's the difference between you saying the market was not reacting to tariffs, but a week or 2 weeks ago when us having that conversation, you had said, I thought that what you were saying is the market was reacting to how this administration
was the same thing.
Unpack that for me.
It's the same thing. The markets knew that there were some amount of tariffs that were coming at the absolute latest after the election in November. They really should have known about it sooner because the polls were telling you that the outcome was going to be what it was going to be. the betting markets were telling you where things were going. So you had a reason as a speculator to already start to consider this was going to be a Trump win, not a Harris win. And everything that candidate Donald Trump said on the campaign trail was tariffs, 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 tariffs. So if you didn't know at the latest in November,
yes,
that tariffs were coming,
got it. Okay,
you were in space somewhere.
Agreed.
The markets did not freak out then. That is to say, they are not afraid of tariffs conceptually. They are not afraid of there being tariff hikes. Or they would have reacted to that news then.
Right.
Why did the markets wait until February in order to react? Because what they're reacting to is not tariffs, but the implementation of fiscal policy, of which tariffs is one thing, the immigration thing is another thing, the government efficiency push and the unwinding of the administrative state, that's a third thing. All of those things are very clearly, if you read the PMIs and you read the consumer confidence reports, and you just take that at face value, and you see what the markets are doing with that information, all of them say exactly the same thing. There is uncertainty about how all of this is rolling out. It's all rolling out in a very shocking, seemingly erratic kind of way. This is not me passing judgment. This is what those surveys say. This is not my opinion. This is what the data is written to show. So now maybe it's the opinion of S&P Global and the Institute of Supply Management and the people they poll for these surveys. Sure, whatever. The upshot is when the markets are presented with this information, when they're presented with those PMIs, that's what they react to seeing. Not the concept of tariffs, but that tariffs as they are being presented, along with more generally fiscal policy as it is being presented, and this apparent tariffs are on, tariffs are off, we're doing this, no, we're doing that. The swift reversals and the sort of appearance of policy that's not forecastable in some sort of a longer form way, this is what's hurting. And the reason it's hurting is because businesses and consumers, when presented with this kind of policy rollout, are saying, I don't know what's going to happen next. I'm going to pull back on economic activity. And this is creating a slowdown.
Yep, I agree with that, and I think that was I appreciate unpacking the nuance. I told you, I give you credit, man. And even if I don't understand, I ask the question versus the challenge. So I've known you long enough, man, and I know you got a big brain up there. So
every time I try to say something faster, it turns out that I have to say it twice as long. So I might as well just be long-winded off top.
So what do I agree with in everything you've said? A lot. I also agree with unloading some long deltas here. I agree with the fact that we're now back at that 5,500 fair value.
The support.
Correct. I think, in my personal opinion, which I want to go through with you, I think Trump, the perspective of what just happened today, I think there is probably going to be some version of people who think Trump blinked, he looked for an off-ramp, and the market found his pain point. The bond market found his reversal pivot point yesterday. I think he just gained a very strategic advantage in these negotiations. And I think that because what you get from a 12% rally in the marketplace is you sort of reward those who sort of bet on positive outcomes. So that's number one. Number two is I think by punishing those who retaliated and basically getting everybody through the first gate who made a deal without retaliating, it gives an incentive structure for negotiations with countries and counterparties. That means, okay, if I don't make a deal now, in the second tranche, what am I going to miss out on? And I had read several papers about that you were going to have like these 2-3 tranches, and those who made a deal or those who cooperated early were going to get better treatment than those that ultimately capitulated or came on board later. And so that there was going to be sort of an incentive structure for this. And I think if anyone like Europe, I think is in a weird, is in an interesting position going forward. I think what I perceived as a strategic error in retaliating so early against China, I sort of assumed, or yesterday I started to question whether or not that was a strategic error. In other words, if your whole point, if you believe that this is not random, it's not erratic, that there is a strategy in place, regardless if you agree with it, if you believe that there is a strategy, and that strategy is as follows. You create an incentive structure to try to get a quote-unquote coalition of the willing. And I think as soon as you went after Canada and Mexico, you could go, this is crazy. Why would we be doing this? These are our friends, whatever. And that is true. You probably catch, what's the saying? You catch more flies with honey than with vinegar.
Sure.
But if you ask yourself, well, why would that be? And what has happened in the past with China going to Mexico to get around Trump's previous bilateral tariffs, you go, well, that probably wasn't optimal. And you probably look at those Trump 1.0 tariffs as a big failure. So if you learn something from that, and that was clearly your objective, if it wasn't just to slap tariff on the world, it's to sort of game into a tariff-free system where you have advantages, where other people help pay to build manufacturing in the United States. And you don't have to take out massive amounts of debts. So in other words, if you want to reform the U.S. economy, but you don't necessarily want to pay for it because we might not have the money, how do you create an incentive structure that gets money in, that spreads across the obligations, that perhaps puts us in a position where we're exporting goods? It changes our debt trajectory. How do you do that? Again, people keep coming for me in the comments. They keep coming for me in emails. They hate, Ilya, that I'm trying to be objective and just see the full distribution of potential outcomes. They hate that I refuse to look at this as just a monkey pushing buttons and can you believe? They hate that. They hate that I'm...
The thing is, you can't think about it that way. If you're going to trade markets and you bring your political bias into it and you let, whatever it is, right, left, you let that color what you do and you close yourself to the possibility of the spectrum of scenarios, you're going to lose money.
I get the people who say that this is not the right way to go about it. There's an optimal path. I get that.
You can think that, but you have to be open-minded to the idea that it's not random.
But the people who are angry at me because I won't accept their worldview, that this is a monkey pressing buttons and there is no plan, there's no strategic objective to this, to what's happening. I think those people are out there, man.
Well, first of all, there's obviously a strategic objective. It's been getting painted forever and a half. You can disagree that this, and I do disagree, that this is how you get to that objective. I think Jon Stewart, actually, of all people, said it really beautifully in his conversation on Monday's Daily Show this week, where he said that what the Trump movement has done is correctly identified the issues, but is pursuing the remedy in a way that he doesn't agree with. I think that's very close to where I'm at, but I'm not going to let any of that influence the way I trade markets.
100%. And so I agree with that. I respect the point of view that, okay, I understand strategically what is happening, and this is why I don't agree with it.
Sure.
The people who get so angry at me because I go, okay, this isn't just an orange monkey pressing some buttons. That's not what's happening here. And if you can't see that, then it's on you. It's not on me. I'll have the conversation about the strategy behind it. But just trying to force me into accepting your worldview, that's not going to work with people anymore, man. That worked for a few years. It's not going to work anymore. Bullying people into accepting your view of the world on Orange Man, it's just not going to work. Now, here's what I will say. I do think, given a 12% rally, and given the fact that I still think earnings aren't going to be horrible this quarter, but I do think everybody's going to kitchen sink it. I think people still want to pay a cheaper multiple on the marketplace, and they're probably going to haircut their earnings expectations. And I still think we're in a growth slowdown, and I still think there's volatility ahead. This is tranche number 1, and we got 90 days. And I think we continue to see the evolution of this discussion throughout 90 days. And I don't think we're out of the woods by any stretch of the imagination. No. I do think 90 days allows us to get through a quarter without this sort of volatility. So I'd like you to respond on the strategery as you see it, and then what you think that does to price, and feel free to opine on your opinion on the rightness or wrongness of the path. Feel free.
Sure. Also, I absolutely see strategy in what's going on. I don't agree with the strategy. If you made me an armchair president here, I would identify much of the same issues, and I think identifying those issues is largely bipartisan. Not to go too deep into the philosophical weeds, but I think if you look at U.S. economic history, it's really very easy to see its evolution and how whenever we solve an issue, we create an issue, and then the next evolution is we solve the issue we've created, which then creates the new issue, and on we go. We start off being poor, growing cotton for England to mill with their new industrial revolution strength. We then figure out, we can get rich if we do this ourselves. So we do it ourselves. And what that does is, after all the world wars and Europe smashed, we're the ones with working factories. So, of course, at that point, we want free trade because we're going to get rich. We're going to sell everything to Europe now. Okay, so we get rich. There's a giant economic boom put on steroids by military spending for the war. That breeds inflation. Then the next fight is with inflation. You get what we end up with: the push to efficiency, the focus for corporations on lowering costs and maximizing shareholder value, deregulation as championed by Reagan, lower taxes, all to bring costs down, in conjunction, of course, with the Fed and Volcker. That successfully kills inflation for 40 years. But what that's done is now created this huge wealth gap, and now and a loss of confidence in government ability to get policy right, and this bloated bureaucracy. It's not difficult to follow how every time we solve a thing, it works, but has a side effect. And when the side effect over time becomes intolerable, we have to solve that as the new issue, which will have its own side effect, and on we go. If you look at the policies of the previous administration or this administration, they're using old ways to try to solve the same issue. The classic kind of left of center thing: more trade, more government spending. Let's throw as much money at the issue as possible. But the problem is you have this expansive administrative state. The money doesn't get anywhere fast enough and nothing actually moves. You just end up with a bunch of inflation and not a lot of structural long-term improvement in the trajectory of all things. You now have the flip side on steroids. we're still solving for the same issues. At some stage, there will be a real solving of this with new methods to say what we need is government efficiency and clarity, and the administrative state needs to work better without losing all of the things we've learned about the benefits of free trade and low taxes and all of that. This is all very academic, and you can watch it in real time and you can track it historically with relative ease. The upshot for me, sort of practically speaking, is if the markets were selling off from, let's call it, mid-February into the beginning of March, because there was a dampening effect on economic activity and the blame was on uncertainty around fiscal policy, and there's very good evidence that that is in fact the case. Purchasing manager surveys from all ends, and even just the pathway of the Atlanta Fed GDP Now model. Never mind the level. The level doesn't matter. What matters is the direction of travel, because it tells you the flavor of the data going in the model. It's sinking. The economy is slowing. What today's announcement does is it resets to a higher value on risk without addressing that underlying issue. And if anything, if you believe that in fact there is uncertainty, it just makes that uncertainty greater, because you've just had, over the course of a week, another rapid policy reversal. That is to say, the next time you have a policy announcement, you can't extrapolate it again. Whether it's good or it's bad, you can't say, I can use this as a basis to make a factory build-out happen for the next year or two. So with that in mind, because you don't know if the tariff will stay, so if you don't know if your margins will hold. So with that in mind, you're back to square one. But sentiment has now given you a mulligan to short at a higher level. The recessionary implications of the environment remain.
I agree. I agree with that. 100% I agree with that. I think the rallies, the bear market rallies, are the sickest and most vicious of any of all of the rallies. So yeah, I would agree with you 100%.
As one Busta Rhymes might tell you, break your neck.
So I agree with what you're saying as the right mental model. I also think at a higher level, and you alluded to this, I think the tariff, and people, I'm trying to be careful not to give anybody too much credit. And yes. I think, Tom said that to me, I think last week or the week before. He goes, you're giving too much credit to knuckle draggers or something of this extent. And I think in some ways people are giving too little credit to the strategic objectives that are playing out. And I think in some ways, thinking everything is part of some master plan, that can also be a very slippery slope to fall into. But there's some part of me that thinks we were already slowing down, Ilya. You and I both believe this. We were already slipping into a growth slowdown.
Or at least the risk was there.
The risk was there.
All of the makings of the risk were there.
No. I would say we were in a bona fide growth slowdown. I would say we were in a bona fide growth slowdown. Now, you were coming from 4% to 3%, so that's not necessarily something that the market was going to get fearful of.
Yes.
But we, bona fide, were already in a growth slowdown, even though people might not characterize it that way.
Yes. The anecdotal evidence was starting to come together.
And I would argue that the reason why the numbers were so goosed is because a couple of smart sort of games that our administration, the previous administration, might have played fiscally and with sort of the Treasury issuance.
Maybe.
I sort of think the Treasury issuance game was necessary, and that's the same reason that Bessent hasn't changed the Treasury issuance strategy. I think there's a lot of need for liquidity at the short end of the curve. I think people don't want to go out on the long end; they want to be on the short end of the curve, so they need more liquidity to make sure.
And we did term out the debt. There just appears to be a really. I mean, the debt is currently the average maturity at the
7
highest
years,
it's
right?
been at the highest it's been in decades. And that was Yellen that did that, but the problem is it's still not nearly long enough.
She didn't go far enough, yeah. So I believe, if you're in a growth slowdown and you don't have the same fiscal impulse as the previous administration, because that's the opposite of what you're trying to do. You're trying to go the opposite direction. You don't want to feed the beast. You want to deleverage the public sector and re-leverage the private sector, as Scott Besson has said. Well, then you're going to go through a period. It's going to get rocky. And the funny thing is engaging in tariffs at this moment in time, for his base anyway, there's an opportunity for him to keep his base, because they're going, oh, this is all just part of the tariffs and the trade negotiations. So there's like this trust element of his base that go with him. And so you're in a growth slowdown / recession, and you could end up with an American people, or at least a base of the administration that goes with him, depending on how high the unemployment goes. If the unemployment goes from 4.1, 4.2% up to 4.4%, where the Fed thinks it's going to go, well, then maybe you can keep a decent level of support with you. If it spikes up to 5%, it gets a little bit ugly. There is 0% chance you can keep the base thinking that this is some positive outcome for them. And I think that's where the political fortunes may change. But I think we're a long way off from finding out whether that's the case. I agree with you. Growth slowdown. We're in a growth slowdown. So then let me ask you, the bond move was absolutely insane.
Bananas.
Let me pull it up on the screen, bro. Like,
ZB in particular. I mean, I had a TLT call vertical that I've been building basically since the bond market broke out going into March. And I've only been adding. And so it pulls back to around where I got in as this week was going. I mean, obviously Monday was absolutely insane. That Monday bar was crazy because last week everything was working as you might expect. Markets get a growth scare, they're selling off, they're buying bonds, expectations for Fed rate cuts are building. You go, okay, this makes sense. They didn't like the tariff announcement because the tariff announcement had a bunch of different rates on a board. They wanted certainty, and what they got was the ingredients for a raft of bilateral negotiations. That means it's going to take a long time. If it takes a long time, that's not the certainty that we wanted. Okay, sell off, right? The hope, I think, that markets had for Liberation Day was he was going to come out and give the plan that captures all the things, and the markets could go, right, okay, I can extrapolate this forward. I like it, I don't like it, whatever. Let's discount this in asset values and keep it moving. But the foam board told them, you can't discount anything. Each one of these is an individual variable, and we're going to negotiate them now. And so the market said, oh, well then, if growth isn't happening because businesses are pulling back on activity because of uncertainty, this doesn't add to certainty. This removes it. This is not what we wanted.
Yeah.
So the markets sell off and bonds rally, as you might expect. I was a very happy camper at the end of last week. I had all the things I wanted. Stocks were falling. It was good. I was short. Bonds were rallying. It was good. I was long. Everything was fine. The move this Monday was shocking. I sort of chalked it up first and foremost to term premium blowing out. And when you look at what happens in ZB versus, let's say, ZT, the front end of the curve, you see it. You don't get these kinds of moves at the front end of the curve because, in fact, the markets are still building, at the start of this week, huge Fed rate cut expectations. And they're pulling them forward. So Fed funds futures at that stage on Monday, when we come in, they're saying there's going to be 6 cuts. 4 of them are coming this year. and 2 of them next year, which is like way off from where the Fed is. And that 6th cut is still debatable, but 5 are fully baked in, and 4 of them are happening off top this year. And then next year, 1 or 2 more. So the pricing is very dovish. The front end reflects that. It's the long end that goes haywire. And I think it's the term premium in there blowing out amid uncertainty, because the Fed is basically standing there after Friday's Powell's speech with its hands up going, I don't know, maybe it's more of an inflation risk, maybe it's more of a growth risk. How we're going to balance it, we're going to wait and see. And so there is no help. And the Fed looks confused along with everybody else as to what the upshot is for their dual mandate. So, and then from that term premium and from that spook, all kinds of market weirdness activate. The basis trade unwinds. Apparently, a bunch of funds in Japan fail overnight around this thing because you get such a big move that the markets start to sell out of long exposure to U.S. debt around these basis trades that essentially just look to game the difference between treasuries and swap rates and extract a little opportunistic mislocation return. And of course, they're levered a gazillion times over because there's not big dislocations in the bond market. So to exploit them, you need all kinds of leverage because they're not big dislocations, but you need to throw a ton of capital to make the trade make sense. So you have this massive unwind and the bond market goes completely bananas. I think what you get today with this crazy long wick and this exhaustion is 2 things. Number 1, the president just told you that there is perhaps a Trump put, if you will, but that the put is not in the stock market, it's in the bond market. That what the president cares about is interest rates, not stocks. And this sort of jives with the differences in his electorate, and it jives with what he's been talking about, debt refinancing and all of these things. And so the president sees interest rates spiking higher and says, that's not what I want. That's the opposite of what I want. Let's put the brakes on this thing. So first, that tells you that maybe policymakers are telling you that there is now a defensible low in bonds. That's one. Number 2, some of the term premium around what the Fed is thinking and the uncertainty with what they may do in response to all of this is surely eroding. Because what we now see, we just read the minutes this morning from the March FOMC meeting. What do they say? We're so afraid that inflation is going to be stickier from these tariffs than anticipated. We think the risks to inflation are biased higher. And what are the markets saying? You all are crazy. Inflation is going down. If you look at the break-even rates in bond markets, they're cratering. Why? Because the markets have already looked through the one-time price adjustment, quote unquote, of the tariffs to their implications for growth. And they're saying that the recessionary drop in demand will overwhelm whatever uplift from the tariffs in the first spot. So if the Fed was only holding back because it's afraid of sticky inflation, the bond market is screaming at them, this is not a thing. You're worried about the wrong stuff. You get a soft CPI number tomorrow, the Fed gets permission to cut sooner. And what you end up with is a growth scare, but inflation going down, not up. As you and I have been surmising, by the way, since that March Fed announcement. We looked at the SEP and said, I buy the growth I buy the growth, but not the inflation.
Bullshit.
I buy the slowdown, but not the reflation.
Because again, it's to me, and I just have these mental models, right or wrong, but to me, the Fed's goal is always and everywhere volatility suppression. And if that's your goal, it's not always. Sometimes they actually need to crack a few eggs and create volatility where there isn't any. Greenspan didn't believe that, but
they are judo practitioners, as we know.
But I think if that's the goal, then what you always need to do is keep risks balanced. And if you see a growth slowdown, how do you keep the risk balanced in the eyes of the market? You throw 2.7, 2.8% inflation in front of them. You create this straw man, boogeyman. But here's the flip side. And this is what I find this is the most fascinating card game I think I've ever witnessed. And it's the most high stakes card game. And you can believe that this is all random. And what are these people doing? And I'm scared and just make me comfortable. You can believe that. Or you can sit in the pocket and try to figure these people out, figure their incentive structures out, and play cards with these motherfuckers. You could do that too.
Oh, the macro
or you can
trading right now is.
Yes.
I mean, this is I love this as a macro speculator. I love markets like this.
Yes.
Because
I agree with you.
This is exactly the kind of stuff that I like to bet on.
Now, do I think it's foolish to look through the risk of the next few months? I do.
Sure.
Do I think the trend is still intact to the downside? I do. Do I think we're still in a bear market? I do. Do I think we're still in a growth slowdown? I do. But I'm trying to look at what the market is priced and what it hasn't potentially given enough credit to. What it's pricing is a low probability that may be a high probability. I'm trying to look at inflationary forces versus deflationary forces. Let's get back to the political favorability, because I think that's going to be a really important calculation. If the baseline assumptions that you and I just made, that we're still in a growth slowdown, that the risk, the pressure to stock prices is still to the downside.
Yes.
And that we are not through a trade negotiation. We only took a step through the first tranche, and it only gets harder with more volatility and bigger claims and more retaliation the further this goes on.
Sure. We've only elongated the process somewhat.
So let's make those baseline assumptions, okay? So then what comes into play is political favorability. If, let's say, I've got a bunch of small businesses throughout all of the United States of America, and what they're doing is buying cheap Chinese goods. They're buying cheap goods from China and they're reselling it on online distribution here in America. And we got a bunch of those, man. And all of a sudden, those small businesses are making a bunch of orders, whether that's business or whatever. Just I'm buying cheap goods from China and I'm selling them over here and I'm making a margin.
Yeah.
Let's imagine right now, all those people, and you can see this on Reddit, you can see this online, all those people are trying to make orders and they're getting sticker shock. They're like, what the hell is this? I can't make my business work. And so in the same way that Trump, when he got in trade war 1.0, what did he do? They sent out subsidies to the farmers. And what I think it has to go into your calculation here, Ilya, in my personal opinion, is that wherever you saw the retaliation and wherever you saw the potential impact then to America, which is his base, because that's what all these people are going to do. They're going to attack his base because that's his vulnerability point. His vulnerability point is his political favorability. So you tariff all the stuff that's going to hurt his political favorability. And so what does he do? Is he either going to allow that to happen, let the natural market forces erode his political favorability, or is he going to respond with subsidies to his base that helps to mitigate the erosion of his political favorability? And I think that that's probably the next card to drop. That at some level, we're going to be talking about subsidization of those who are negatively affected by those who have retaliated. And we ratchet up the retaliation on others. We create disincentives for additional retaliation to us, and we continue to offset those Americans who are going to be negatively impacted by tariffs. What do you think about that potential tit for tat, about the potentiality of that sort of as we move forward here?
I think what that paints is exactly sort of adjacent to why the idea that has been circulating around, and I'll sort of kill two birds with one stone because I think these are adjacent ideas. So I'll moot them at the same time. The idea that actually what the administration is doing is it will inflict the pain purposefully. And that what inflicting the pain will do is bring down interest rates. Ultimately, obviously, that whole supposition blew up in the administration's face in this very short window of time that we've seen it so far. Who knows what will happen over time? I actually think interest rates are going lower. So I'm actually with the administration on this. I think what these actions will do is ultimately bring lower rates, not higher. But at least so far, their supposition has blown up in their face. Maybe they're wrong and I'm wrong. But the presumption has been, look, we're going to crush the economy. We're going to bring down rates. That will help us to refi debt. And we're going to buffer people we like, much as you just described, with subsidies, with transfers, through the pain of making the adjustment, because what we want is a big refi of debt at much lower levels. I'm not saying that's not the strategy. I don't know. I'm saying if it is the strategy, and if the idea is basically to wave a big hammer at everybody and to purposefully crush growth while favored sort of groups get support, I think it's a bit like saying, I have a sprained ankle, let's amputate the leg. Here's why.
Mm-hmm.
If you cause a recession, and the markets are telling you this because the break-even rates and other measures of inflation expectations are cratering. They're telling you this. This is not sort of out of thin air. They're telling you that the disinflationary impulse from recession will be greater than the inflationary impulse from the tariffs. And maybe that calculus changes if you give out a bunch of subsidies, but then your desire to reduce the deficit is set back. Moreover, in a recession, all of your outlays increase because now you're on the hook for unemployment benefits and all manner of other things at the same time that business is down, and so tax receipts are falling. So you're trying to save a couple dollars on interest at the expense of losing much, much, much more because you have a ton of money going out and less money going in a recession. So, and if you decide to give your favorite constituencies a little bit of a sweetener, that's just more money going out. So, to me, strategically, it's not logical to do it this way. That doesn't mean that that's not what's going on and that's not what's going to happen. I do think the markets are already looking through to what the downturn will be, and they're reckoning that it will be a disinflationary downturn in its severity, even with an uplift and a shock to prices from some amount of tariff. So
I think I agree with everything you just said. But I don't think that's exactly what I'm framing up. I think the part you added was that the administration's ultimate goal is to get rates lower.
Yes.
I think that's a positive outcome for them. But what I'm saying, though, is I'm simply trying to be objective and trying to figure out, do I want to bet on the long end or not?
Yes.
Last night when I saw just absolute pandemonium, and I tweeted this out, as I was watching this, I said somebody just got carried out on a stretcher, meaning like when you see this type of disorderly market function, a lot of the times what's happening, this was in response to a tweet by Jim Bianco. He said, something is broken tonight in the bond market. We are seeing a disorderly liquidation. And I think when you see liquidations, well, here's what tends to happen, right? I got a shitty position I got to get out of, and the whole market knows it. They're going to take my eyeballs out. They are not going to give me fair prices to liquidate. If I've got a boat full of long bonds, I got a boat full of long bonds, and I got to get out of the position. You know what the market does? They fucking drop rates 5 points because I got this gigantic position I got to get out of, and they rip my eyeballs out. But what that means is, well, look, there's probably a decent risk reward that if that's what's happening, if this is not just a wide-scale unraveling of the U.S. financial system tonight, if that's not what's happening and this is a liquidation event, then this might be an interesting risk-reward area. It's hard to push that button, bro. But I make as much money on them because you get the vol crush because vol went crazy stupid yesterday. So the direction, the delta is sort of offset by the Vega. But yeah, I sort of thought what was happening yesterday, people were panicking that it was effectively the fall of the bond market, right? We were in the midst of a debt crisis. And I go, that could be. But what also could be happening is somebody's blowing up and the market is taking their eyeballs out. And if that's true, then everybody's over-rotating the wrong direction here.
Here's how I knew.
Here's
how I knew that what you're saying is right. Everybody was running around screaming, you know what this is? This is China retaliating. They're dumping some amount of treasuries.
I thought that could be possible.
They might have sold something into the rally, but the idea that what this is a targeted Chinese policy response. By the way, it's a dumb policy response, but dumb policy responses are all the rage now. So who's to say? But what you did not see, and this was absolutely critical, was you did not see the dollar sell off. Mm-hmm. If there was an exodus out of U.S. assets, the dollar would get trashed. Yeah. And while the bonds were selling, the dollar was rallying. This was not an exodus from U.S. assets. It was a cashing out of positions. Because the money went back to dollars and stayed there.
I think you're exactly right. And one of the things, Jim Bianco pointed that out yesterday as well. Let me read this for people just to enhance the point that Ilya is so astutely making. I don't think this is China selling bonds to punish the U.S. over rates. There are no good daily statistics to measure this, but I still contend that if this were happening, the dollar would be declining. The dollar index is up since Thursday's low, suggesting net foreign buying is coming into the U.S. market. Above said, technically, China could be selling and keeping their money in overnight repo accounts. If they did this, it says two things. One, they are not afraid to dump treasuries and drive up yields and punish, but they are afraid to take cash from these treasury sales and convert it to another currency, or in other words, dump dollars. Why is it okay to crush the bond market but not the currency market? Answer, it does not make sense. Or two, if they are selling treasuries and continue to park them in U.S. repo accounts, they are not really serious about punishing the U.S. Again,
well, of course,
the most logical answer is that they are not the primary seller of the treasuries, if they are the seller at all.
This is the only place that I will diverge from Jim. Obviously, I agree with him because I just said the same thing before having seen this, and I was saying it to Chris on air yesterday. So obviously, I think Jim's right. I agree. Where the only sort of caveat is, and it's not a material caveat, but it does make sense for China to sell off treasuries and then keep the dollars and not repatriate them. Because we are still the largest trading partner, and they don't want the yuan to appreciate against the dollar. They do not want the dollar to strengthen because that would make an already very challenging export environment that much more challenging. So it does make sense. It just still doesn't make sense that that's what they're doing. Because if this was an exodus from U.S. assets by China, China doesn't have to repatriate dollars. The markets are going to sniff that out instantly, and they're going to dump dollars. So no, the same logic holds. If the dollar is holding up, that's not what's going on in my mind. There might be logic for China not to recycle their dollar cash proceeds out of dollars, but do you think the markets aren't going to notice a large Chinese unwind of their treasury position and not front run that? Well, I have any number of bridges that I could sell you.
What do you, 3 months from now, 6 months from now, 1 year from now? Like, I can't help thinking, Ilya, we go through the pandemic response, and we passed the CARES Act, kind of shut down the economy. The winner in all that is large multinational corporations with tons of cash that can weather periods of volatility. The loser in all that is the mom and pop shop that sometimes has good months, sometimes has, needs to get a loan just to make it to the next month or the next quarter, or has a good year and a up year, down year. Those businesses with that level of variability, they go by the wayside. And what you end up with is less small businesses and more consolidation of large corporate power.
Yes.
And I can't, regardless of sort of how this ends up, which I think is with some creative destruction.
Yes.
I don't see how this doesn't end up with just consolidated corporate power and smaller businesses, but in different areas of the economy. Maybe it's not the restaurants this time around. It's the drop shippers. It's the people running the online stores. I can't help think that this is going to take from an area of small business in the economy, consolidate even more multinational corporate power. I wonder if you could opine on that for a bit.
I mean, I think your instinct is correct. I am less optimistic as much as that. So I am less optimistic, but I am also more optimistic, and I'll explain what I mean.
Okay.
I am less optimistic because I think in addition to hurting small businesses, and I completely agree, that's exactly right, and it's going to hurt small banks, it's going to hurt anybody at a certain level of scale below the ultra huge. Because the ultra huge are going to be able to have the capital reserves to weather it, and everybody else will just choke on the volatility. And I think that's right. I think that's going to come. And I think that'll be the essence of the recession. And with that, probably the scariest thing is, in addition to coming for those businesses, it's coming for consumers. Consumers are going to get absolutely trashed by this. Because if what you are saying, if the strategy is as presented, you're forgetting that when you were president the first time, you did steel and aluminum tariffs, and what you ought to have learned is there are many more steel users than steel makers. And if you start to hand out, because all this is big government. This is just a different stripe of big government.
Yep, I agree with that 100%.
But this is more big government. There's a great book by one Ruchir Sharma that's called "Why Capitalism Failed," and I do not endorse it in its in all of its conclusions. I actually disagree with quite a lot there, but it's telling of economic history, and it's identifying of the fact that the Reagan Revolution never really happened. It's just regulation moved. Government still got bigger. It just moved from one place to another. That all the attempts at deregulation that Clinton did, for example, getting rid of Glass-Steagall, it just made the regulatory state bigger because now you need all these extra rules in the reform. And that what this is a theme now, really going from the fight with inflation in the 70s going into the 80s to the 80s being sort of that fight starting to bear fruit, the push to lower prices, increase efficiency, deregulate on the surface. But every time you deregulate, what you're really doing is you're just rewriting the rules to open up one thing while you create a gazillion other confusing things around it to make that happen. And so, whereas, let's say, maybe the original Glass-Steagall Act was like 40, 50 pages, the undoing of it is like 10 times that.
Uh-huh.
And so, really, the issue here is that what you have is big government, but whereas the Biden version was spend a ton of money and try to grow your way out of debt, this is big government through a tariff administrative state. Yeah. But it's ultimately the same thing. It's just it's just a different flavor of the devil.
I said the same thing, Ilya. I said that if you didn't like Biden's subsidy economy or the method of big government, then in theory you really should not like a Trump tariff government. It's consolidated centralized power with the power of the printer on one end, and it's consolidated centralized power with a disincentive. Instead of the incentive, it's a disincentive of the tariff on the other, but it is a mirrored opposite of each other, the flip side of the exact same coin. I agree, Ilya.
And so this is where I'm optimistic.
This is where I'm optimistic. I land somewhere in the middle that I get what you're saying. That's the most gangster point. I land somewhere in the middle that I'm still holding out that the happy path here, the most optimal path for the Trump administration is to land in a world of tariff-free trade for the most part, with some small carve-out exceptions that are simple, clean, and straightforward. If you get anything other than that, I think what you have is something that you do not want, but you don't know that you don't want it, even if it has a positive outcome, which I readily admit has small probabilities, but I think those probabilities just increased with the play today. That's my read on it. When do you think the sugar high wears off, Ilya?
Possibly
the sugar high
as soon
of
as
today's
tomorrow.
event?
Possibly as soon as tomorrow. Possibly as soon as tomorrow. So for me, it's exactly this. It's most of us who are sane, I think, like you, fall in the middle and say, the problem that we needed to solve with free trade was inflation. We needed to open up the economy. We needed to focus on efficiency. We needed to bring down costs because the inflation coming from the 70s into the 80s was catastrophic. And we did that with apparently the economy that we're trying to go back to. We seem to be forgetting that what it did last time, by the way, everybody was cheering Biden initially from a certain perspective as the next FDR. Well, FDR and the very expansive with an A, government spending that started with the new deal and then, of course, ramped up for World War II. That's how we got both the post-war boom and the inflation that it created. And nobody, I think, should be so silly as to say that the huge leap forward that was the GI Bill and the prosperity of the 50s are a bad thing. But they had consequences. And the consequences then had to be resolved. I think Reagan, if you want to pick a touch point is the place where you start to get the shift. And you go, okay, the focus now will be lowering prices for things. And it's the Fed doing what Volcker is doing, but it's also freer trade, a focus in corporate governance on shareholder value and efficiency. And for 40 years, we managed to kill inflation and bring costs down. Free trade is a thing that we constructed to fix a problem that we made. We did it ourselves. And again, it has a cost. We did it, and it worked, by the way, at solving the problem that we set out to solve. It just had, as always in economics, there's no such thing as a free lunch. And so what we had were costs associated with our fix. The income inequality, the ridiculous appreciation of financial assets relative to labor and wages. All of that is the thing we're going to work on now. And we just had an attempt by the left side of the spectrum to fix it by spending a lot. We're now getting an attempt to fix it this other way. I think ultimately what's going to happen is the happy medium. And whether it's this administration that does it or the next one, I think we're sort of groping our way to what is the real solution. Which is to say we need free trade and allies, and it's ultimately beneficial. But what we need to do is be good at making whole the minority that suffers a net loss. And what we've ended up with now is the flip side. If free trade gave us a majority that benefits and a minority that loses, and we need to compensate that minority, what we have now is protectionism, so a minority wins and the majority loses. We're not solving the underlying issue with these old paradigms. We need a middle ground. And the one you're describing is about where I'm at. Mostly tariffless, frictionless, free commerce, and carve-outs for specific things like national security and crazy dictatorship-like countries who, in their mismanagement of their own economy, are going to get feisty probably because an angry beast is more dangerous than a complacent one. China has been in a deflationary spiral going on 2 years. We should start thinking about maybe they'll lash out at some point just because they're losing their grip on their own country. Much as Russia has lashed out against Ukraine because Putin was losing his grip on his country. And so
I would argue we are lashing out.
I see a middle ground.
I would argue we are also lashing out because
at ourselves, though.
At the world, because our primacy, we are also sort of losing our control both internally and externally as well. I think there's a lot of that happening, but I agree with you.
The reason I think we're lashing out 100%. At ourselves is because we were lashing out at a system internationally that we built and that served us as intended. We didn't take care of what we should have known to be the costs, and we should have learned those costs a long time ago. Those of us that are
we did know
because anybody
just didn't do anything about it.
We didn't do anything about it. Those of us that are readers of people like David Ricardo and Adam Smith, all proponents of free trade, especially David Ricardo, going all the way back to the Industrial Revolution, were telling us free trade is good for most people, but there are costs. If you're going to do it, you need to address the costs.
And one group believes that the problem with redistribution of wealth, just straight redistribution, is that the marginal propensity to consume of one group is higher than the marginal propensity to consume for another. And so what you end up getting is inflation in the economy as you redistribute that wealth. So instead of redistributing it directly as pure cash. You redistribute it through government services that improve the welfare of those that have high marginal propensity to consume, and thereby managing sort of prices in the economy. And that may be true, but I think
common sense would tell
about
you
the redistribution at all. Like the roads.
Well, that's right. I mean, common sense would tell you.
The schools are shit.
Common sense would tell you, if you need a defensive capacity to build steel at home, and the problem is you're displacing steel-making jobs, then what the government should do is have a strategic steel reserve like it has a strategic oil reserve and say, you know what? The cheapest possible steel may be this other way, but we need a strategic reserve, so some capacity has to stay here, and we'll buy it ourselves.
I'm going to ask you to react.
And you can do that across a whole number of things and have a
That's
sane
also big
policy.
Too.
No, but have a sane policy where you have small carve-outs, not
I'm with you.
You're trying to fix everything with a sledgehammer this way or that.
Well, we only have a few minutes left in the show, and I'm gonna be respectful of the guys behind the mics, because I went over by like 15 minutes on Monday, and I just didn't even know. So I don't want to do that again. I was by myself too. I want you to react to two things if you could before you get out of here. The first one is a tweet by Bill Gross. He said, this market crash will affect millennial and Gen Z investors for long to come. What before was a can't-miss way to make money will induce caution and more conservative attitudes, resulting in lower PE ratios, higher yields, and single-digit returns. You and I have had this similar conversation, but in 2022,
yes,
I think this is not going to happen year over year. It takes some time. And what you and I said at that point is you change the cost of money, you change a lot of things. And over time, we might have pulled forward a lot of returns in that ZERP period. And if you've pulled forward a lot of returns, you've pulled forward what is there to share across the next 5 to 10 years. Your reaction to Bill Gross's tweet here?
I think your time component here matters a lot. And you know this because you and I have been talking about this for years and years now. I have believed that COVID was an inflection point for inflation, whereby we had 40 years of inflation going systematically down. We just described sort of the macro perspective why. And interest rates following it down because that's exactly what they're supposed to do. And what COVID did was it marked the break, not because COVID, we started the shift earlier, because it's really a demographic shift. But what COVID put on steroids was sort of all the elements of the shift into a more inflationary environment that will require the Fed to have higher structural rates. That elusive natural rate, neutral to growth versus inflation, that's neither expansionary nor contractionary, that it's now leveled up, that it's higher now, because there is a inflationary impulse from the demographics of aging populations and less labor supply, and also from our souring on globalization to some extent. And if globalization brings prices down by creating efficiency and frictionless commerce, deglobalization does the opposite. It adds costs. And so you're going to have a most slowdown, and break-even rates are telling you that interest rates are going down, that the Fed is going to cut more, not less, because they have a growth scare to deal with that's in front of them more immediately. So I think what you think of what Bill Gross is saying here depends on your time horizon. Near term, no. Bigger picture, probably.
I think the lesson over the last couple of weeks is, especially in the last week, if you don't like the risk in your portfolio, you just got a real-time stress test. You didn't have to, if you weren't running sort of, looking at your risk profile and running 1, 2, 3 standard deviation, 4 standard deviation possibilities on what your risk looks like. You just got a free real-time simulation. And it also allowed you to process your own emotions. I think the lesson in this week isn't to come out of this and have some, glad that is over. Yes. I think that would probably be a mistake. But I think what you learn about the last 3, 4, 5 days is, do you like the risk you had on? And if not, they just gave you a mulligan for the most part.
Yes.
They just gave you a mulligan. And if you didn't like the risk, don't come out of this thinking, "Oh man, glad I got out of that," and you don't do anything about it.
Yeah,
if you don't like what you just saw, right? If you don't like what you just saw, then you're getting a mulligan to adjust the risk in your portfolio, and ensure that you're in a decent place to weather what could continue to be a bumpy next couple of months. I ultimately think that this is I don't see where this doesn't end in a big print. I don't want to say that. I think the probability of that tail scenario on the left churning into a hard right tail scenario, I still think it's always there, and you never want to forget about it. Mm-hmm. So anyways, that's what I think the takeaway is for me, and I think that's the takeaway I'd like to share to everybody out there. Ilya, what do you think the takeaway is for you, and then what do you do with risk going forward until the next time I get the opportunity to talk to you?
So I'm out of my stock longs, synthetic stock longs, because I was a put seller on Monday. I got out of it today in the second half of the day. I didn't catch the entire 9%, but I caught about 7.5. La-di-da, great. I don't have any confidence in this move, especially given where it stopped. If you're any kind of watcher of price action, you can see that we're basically back to the starting line of the Liberation Day gap. So, and we're at the underside of a range that held for a few weeks before that. So you have a reset. And so I'm looking to now be a seller of risk. I want some sort of a signal that tells me we're going to hold this former support as resistance. So I'm hanging back. I'm going to see the price action tomorrow. I think the CPI numbers could be a real potent thing, because if they come out soft, then on the one hand you get confirmation of the growth scare. On the other hand, you let the Fed do the thing that they want to do, which is cut rates. You basically give them permission, or at the very least, the markets can speculate that the permission has been had, because the FOMC minutes told you their big thing was an inflation shock, and the break-evens and then the CPI are telling you, no, wrong. Stop that. Go ahead. And so with that in mind, I think bonds higher. I still have that. I think maybe that washout in term premium continues, because the markets now get a clearer direction for the Fed. I think stocks are vulnerable, and I'm going to be looking to sell them once I get the Q. I think because yields are going down, because the market will be more confident in Fed rate cuts, the dollar is going to go down. And so one of the things that was a nice sweetener for me today was the dollar got absolutely crushed, and I've been short. I'm short against the euro. I'm short against the pound. I'm short against the Aussie. I'm short against the Canadian dollar. I started rebuilding my dollar short last week with the Canadian dollar. In fact, I just doubled down on the Aussie last night as the bond chaos was going on, saying this seems like it's weird. I can't do anything with my TLT position, but what I will do is I will buy a bunch more Aussie dollars, because this is not what they're saying that it is. It's not China. The Aussie dollar would be cratering, and it wasn't. And so I bought a bunch of Aussie dollars. That's working. So short dollars, long bonds, eventually short stocks again. I started to get a little bit short crude oil as well, because I think it's basically leveraged to growth. And if you get the recession scare plus the disinflation, that works on the downside from here.
I am long bonds too, but not for long, only because they gave them to us. I didn't catch the low at 110. I think I got in at 112. So I'm a little long there, but the only thing that I have a little bit of a challenge on is I just have a challenge on the long end getting too bulled up. I think this time is a little bit different when it comes to long end yields. I'm not saying they're not going to fall. I just don't know that the risk and reward is there to have the type of upside that we would typically have in a typical recession, especially if you're going to get a mild one.
I think the upside is before the Fed starts cutting, because I think the speculation now is more cuts later. And I think that's going to show up in the long end. When the Fed actually starts cutting, the move might already be over.
Yeah. We shall see. We shall see, man.
Yeah.
That the fiscal situation, it just gives me so much pause here. And I actually think the weirdest thing is, if the administration is successful to whatever that means from the market's perspective, I think that it's all about changing the debt trajectory. So in a weird way, if there's some end moment where we get to a finalized deal and the market has clarity in what the rules of the road and the terms of trade are, and that in some way has been successful at changing the debt trajectory of the United States, in that moment, or in the lead up as the market projects that moment is coming, I think that's the moment at which you get restored confidence at the long end. I think that's the moment that gold sells. I think that's the moment that probably Bitcoin sells. I think all of those alternative stores of value have a very, very difficult time, and the traditional stores of value and sort of the U.S. Our current monetary system potentially start trading at a premium again. Ilya Spivak, it is always a pleasure, man. This ended up being one of the best days to have a conversation with you, and I'm sort of glad how things shifted out this week. Ilya Spivak, if the people want more from you in navigating what is a highly complicated, highly volatile environment, and they want your big brain next to them on their desk as they navigate this environment, tell them where they can go.
As always, I'm all over the network in the PM hours. I'm obviously here on the West Coast, so I'm getting up later. So I'm all over the network in your PM hours, be it overtime or macro money or this show, all week long. I am writing for the News and Insights part of tastylive.com. I'm commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. I'm all over the place, and I'm in what is one of the funner periods for a macro trader. We spend a lot of time looking at grass grow and paint dry as macro investors, but this is exactly the kind of thing that I enjoy in markets. Macro dislocation and the opportunities therein. So I am putting out as much content as I can possibly do.
Yeah. Isn't it wild? You were relatively bearish and you caught a ripper. Congratulations, by the way. I was constructive. I wouldn't call it bullish or balls. I was just constructive about the opportunities that could come along. And we're both on this podcast with big smiles on our face.
Yeah,
and that's sort of the interesting irony of the marketplace. Ilya Spivak, I enjoy the conversation with you more and more, quite frankly, as time passes. Same thing with Chris Vecchio. I enjoy the opportunity to express dissenting opinion in a respectful way. If anyone wants to do that with me, hit me up on @VictorJones. The O in Jones is 0 because I like to be difficult. And just as I said yesterday, if you'd like a more private one-on-one conversation, I answer all my emails. So send me a note, victor.jones@tastylive.com. The only thing I ask is keep it respectful. You give me respect, I'll give you mine, even if we have disagreements on how to look at the world. I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.
Peace.